Welcome to the course on building blocks of trading. In this course, you will learn about the basics of financial accounting and investments finance. Specifically, we will cover the following topics: reading and understanding financial statements, specifically the balance sheet, the income statement, and the statement of cash flows. This will focus on the definition of the various items that make up these financial statements. We will also discuss the difference between accrual and cash basis. Using information from the financial statements, we will define, calculate, and interpret some common financial ratios. We will look at the following sets of financial ratios: liquidity ratios, solvency ratios, activity ratios, profitability ratios, market price ratios. We will then move on to topics on investment finance and talk about the risk-return relationship and the idea of diversification. Here we will discuss what type of risk is priced and present some theoretical asset pricing models like the capital asset pricing model and arbitrage pricing theory, and an empirical asset pricing model. Next, we will cover topics on the different types of orders a trader can place, what the order book is, and how orders execute against the order book. We will also discuss some common ways to measure transaction costs. Finally, we will focus on what hedge funds are and some of their common trading strategies. By the end of this course, you should have a good understanding of how to read and understand a company's key financial statements. You will also have an understanding of what the risk-return trade-off is and how exactly they are related through asset pricing models. You will also have an understanding of how markets function and, as an investor, how to measure your transaction costs. Learning outcomes. After watching this video, you will be able to define what accounting is, briefly describe the three types of accounting, discuss what accrual accounting is and its pros and cons. Before we define the different financial statements companies typically report publicly, let's broadly look at what accounting is and the different types of accounting. Accounting is the formal collection, aggregation, analysis, and reporting of financial and non-financial data about a company to various end users. Some of the financial and non-financial reporting is mandated, and the companies are required to release these periodically, typically quarterly. Accounting itself comprises of three types. One is financial accounting, two is managerial accounting, and three is tax accounting. Financial accounting provides information about the company to people outside it. Managerial accounting provides information about the company to those within it. Finally, tax accounting is the estimation of taxes to be paid and the compliance with tax disclosures. The primary purpose of financial accounting is to inform outsiders about the financial performance and health of the company, which will assist them in their decision making. This could be for valuation purposes by equity investors and investment banks, and for assessment of credit risk by banks and suppliers. A secondary purpose of financial accounting is to monitor and evaluate the performance of managers and to ensure that its managers use the company's resources responsibly. Financial accounting communicates to outsiders through financial statements and additional disclosures, all of which are a part of the company's quarterly and annual reports. These reports are audited for accuracy and conformity with accounting rules. The primary purpose of managerial accounting is to provide information for decision making within the company. The information provided through managerial accounting helps determining product costs, profitability and pricing, determining product mix, introducing and discontinuing products, and capacity planning and determining production volumes. A secondary purpose is for performance evaluation and cost control. Unlike financial accounting reports, there is no fixed format for managerial accounting reports and they are not audited. Tax accounting provides information to tax authorities. It is legal to prepare separate statements for tax and financial purposes as some of the rules used to prepare statements for tax purposes may differ from those used to form financial statements. In this course, we will focus only on financial accounting. A key element of financial accounting is the idea of accruals. Financial statements are based on accruals rather than on cash basis. That is, transactions are recognized on financial statements as and when the primary economic event occurs rather than when the actual cash flow occurs. This accrual-based accounting allows the verification of earnings and the net financial position of a company during a period. This accrual-based accounting gives rise to two major financial statements, namely the income statement, also called the profit and loss statement, and the balance sheet. Accrual accounting occurs through the process of revenue recognition and matching costs to revenues. Revenue recognition means that a company can report revenue that is earned through delivery of service or product, can measure this revenue, and is reasonably sure of receiving this revenue. Matching cost to revenues means that expenses directly related to revenues are recognized in the same period as the revenues are recognized. It also includes expenses that are not directly related to revenues but are recognized as expenses over the time period the benefits are realized. In a nutshell, accrual accounting says that we do not have to see the cash to record a transaction. The advantage of accrual accounting is that since transactions are recorded when the economic event happens, the financial statements provide timelier and more decision-relevant information. On the other hand, accrual accounting is based on judgments and estimates and so less reliable than cash flows. As the common adage goes, cash flow is a fact, earnings is a matter of opinion. For this reason, financial accounting is guided by well-specified rules. But these rules do give some room for managerial discretion, which is why external auditors audit financial statements. Next time, we will start looking at some of the common financial statements. Last time we introduced the idea of accounting and the three types of accounting. In this video, we will talk about the balance sheet and define its three main parts. We will also briefly discuss why the balance sheet is called so. The first financial statement we will look at is called the balance sheet. It captures the financial position of a company as of a particular date, either the end of a quarter or end of a year. It consists of three parts: assets, liabilities, and shareholders' equity. These parts show what the company owns, what it owes, and how much shareholders have invested in the company. Assets represent the resources owned by a company and are used to generate future economic benefits in the form of either higher cash inflows or lower cash outflows. Examples of assets are cash and equivalents, inventory, property, plant and equipment, and intangible assets like patents and trademarks. Assets are further classified into current and non-current assets. Current assets are those assets that are expected to be converted to cash, sold, or consumed within the next 1 year. Any asset that is expected to be converted to cash, sold, or consumed after 1 year is categorized as a non-current asset. Liabilities represent a company's economic obligations to outsiders. These outsiders have claims against the company's assets. Examples of liabilities are accounts payable, short-term borrowing, and long-term debt. Similar to assets, liabilities are also classified into current and non-current liabilities. Current liabilities are those that are expected to be paid within 1 year, while any expected to be paid after 1 year is a non-current liability. The last part of a balance sheet is the shareholders' equity. This represents the company owner's claims on the company's total assets. It consists of owners' investments in the company as well as aggregate undistributed profits called retained earnings. The balance sheet gets its name as it has to balance out at all times. That is, assets must equal liabilities plus shareholders' equity. Assets represent how the company uses its resources, whereas liabilities and shareholders' equity represent where the company gets its resources from. These must equal each other at all times. One of the important things to remember about the balance sheet is that all items are recorded at historical cost. They are never updated to current market values or prices. In a balance sheet, assets typically appear on the left side or at the top, and liabilities and shareholders' equity appear on the right side or at the bottom. However, this may vary from country to country depending on local accounting rules. In some countries, the order may be reversed. Next time, we will start looking at the balance sheet in greater detail, starting with the asset side of the balance sheet. Last time, we introduced the basic structure of a balance sheet. In this video, we will define what current and non-current assets are, as well as look at the different items that constitute these two subcategories of assets. This will help you in understanding the asset side of the balance sheet in greater detail. We have already seen that assets tell us how the company uses its resources. Assets in turn are broken down into current and non-current assets. Current assets are those that are expected to be sold, converted to cash, or consumed within the next year. Everything else is a non-current asset. Examples of current assets are cash and cash equivalents, inventories, and receivables. Examples of non-current assets are plant property and equipment, typically denoted by PP and E. Over the next few videos, we will use Amazon.com Incorporated's financial statements from December 2015 and where necessary also from December 2014 to better illustrate and understand the various items that form each financial statement. The financial statements are from Amazon.com's annual report for the year ending 2015. Let's take a detailed look at the various items that constitute current assets. The first item under current assets is cash and cash equivalents. It includes currency, coins, checks received but not yet deposited, checking accounts, petty cash, savings accounts, money market accounts, and short-term, highly liquid investments with a maturity of 3 months or less at the time of purchase. At the end of December 2015, Amazon had cash and cash equivalents worth $15.89 billion on hand. The next item under current assets is marketable securities. These include investments in various types of financial securities like stocks, bonds, etc. They are not as liquid as cash and cash equivalents, but may be converted to cash easily. Amazon had marketable securities worth $3.92 billion at the end of 2015. Cash and cash equivalents and marketable securities make up the investments part of current assets. The other two items that constitute current assets are related to the company's operations. These are inventories and accounts receivables. Inventories include all raw materials that the company has bought, all work-in-progress products, as well as all finished goods. Not all these sub-items may be relevant to all companies. For example, companies in the services industry are unlikely to have a large inventory of finished goods or even work in progress. Almost all of its inventory may be the cost of supplies that the company has bought, which will be used in the delivery of its services. For Amazon, inventories stood at $10.24 billion at the end of 2015. Books, consumer electronics, and other consumer goods that it sells through its website is likely to make up a large fraction of this $10.24 billion. The final item on the current assets part of the balance sheet is accounts receivable. This includes all the money a company's clients owe it. When companies sell their products and services, they will not always insist on cash payment as soon as the product or service is delivered. The client or customer may be given a few days to a few months to pay. In other words, the client is extended credit for a fixed period of time. While the company waits for the customer to pay, the value of the sale is recorded as an account receivable. This signifies that the company has delivered its product or service to the client or customer, but it is yet to be paid. The client has an obligation to the company, and hence it is an asset for the company. Amazon had accounts receivables of $6.42 billion at the end of 2015. In its annual report, Amazon notes that most of this amount is due from its customers, vendors, and sellers. Adding all four components gives the company's current assets. This represents cash as well as assets that will be converted to cash within 1 year. Amazon's current assets add up to $36.47 billion at the end of 2015. Turning our attention to non-current assets, the largest and most important contribution to non-current assets is plant, property and equipment, PP&E. This includes all land, buildings, machinery, office equipment, vehicles, furniture and fixtures that a company uses to run its business. Amazon had $2.84 billion in PP&E at the end of 2015. Amazon's annual report for 2015 notes that this includes buildings and land that they own, along with property that they have acquired under build-to-suit, financing, and capital lease arrangements. Their equipment includes assets such as furniture and fixtures, heavy equipment, servers and networking equipment, and internal use software and website development. The other major part of non-current assets is intangible assets, which includes non-physical assets such as patents, trademarks, copyrights, goodwill, and brand recognition. These intangible assets add to a company's future worth and at times may be more valuable than tangible assets. Amazon had goodwill worth $3.76 billion under non-current assets at the end of 2015. Additionally, it had some miscellaneous other assets worth $3.37 billion. PP&E, goodwill, and other assets totaled up to $28.97 billion in non-current assets at the end of 2015. Given current assets worth $36.47 billion and non-current assets worth $28.97 billion, Amazon had total assets worth $65.44 billion at the end of 2015. Remember, assets represent how a company uses its resources. But where do the $36.47 billion in resources come from? This is what the liabilities and shareholders' equity part of the balance sheet tells us. We will look at a detailed breakdown of a company's liabilities next time. Last time, we talked about the asset side of the balance sheet, which reports the uses of a company's resources. In this video, we will discuss where a company gets some of these resources from, namely the liability side of the balance sheet. This will include looking at the two parts of liabilities, current and non-current liabilities and their various constituents. We will continue to use Amazon's balance sheet from December 2015 to better understand liabilities. Similar to assets, liabilities are also separated into current and non-current liabilities. Obligations that are due within the next 1 year are classified as current liabilities, and everything else is called non-current liabilities. Examples of current liabilities are accounts payable and short-term borrowing. Examples of non-current liabilities are long-term debt and long-term lease obligations. Let's take a detailed look at the key items that constitute current liabilities. The first item under current liabilities is accounts payable. This is how much the company owes its vendors and suppliers for products and services that they have already provided or delivered. It represents how much products and services the company has purchased on credit. These are expected to be paid off by the end of the year. Amazon had accounts payable of $20.40 billion at the end of 2015. A second item under current liabilities is accrued expenses. These are expenses that the company has incurred but has not yet received an invoice for. Examples of accrued expenses are wages, interest, and utilities. The company has incurred these expenses as of the balance sheet date, but it has not yet received an invoice for these expenses. Wages will fall under accrued expenses if payroll for that period has not yet been processed. As of the end of 2015, Amazon had accrued expenses of $10.38 billion. Amazon's annual report notes that these accrued expenses are primarily related to unredeemed gift cards, leases and asset retirement obligations, current debt, acquired digital media content, and other operating expenses. A third item under current liabilities is unearned revenue. This is how much customers and clients have paid in advance for the company's products or services. This will continue to be a liability for the company until it delivers the promised products or services. At the end of 2015, Amazon had unearned revenues worth $3.12 billion. Its annual report notes that unearned revenues primarily relates to prepayments of Amazon Prime memberships and Amazon Web Services. Adding all three components gives the company's current liabilities, all of which are obligations due within 1 year. Amazon's current liabilities for the year ending 2015 are $33.90 billion. Moving on to non-current liabilities, the largest contribution is from long-term debt. This includes loans and bonds, all of which are due to be paid after 1 year. At the end of 2015, Amazon had long-term debt worth $8.23 billion. It had other long-term liabilities worth $9.93 billion at the end of 2015. Its annual report reports that the long-term liabilities primarily consist of long-term lease obligations, tax contingencies, and long-term deferred tax liabilities. Remember, all these obligations are due after 1 year for them to be counted as non-current liabilities. Amazon's total non-current liabilities at the end of 2015 add up to $18.16 billion. Adding this to its current liabilities of $33.90 billion, Amazon had liabilities worth a total of $52.06 billion due at the end of 2015. Previously, we saw that Amazon had total assets of $65.44 billion, which is how it had used its resources. Liabilities provided $52.06 billion of the required resources. Where does the balance $13.37 billion in resources come from? We will talk about this next time. Last time we talked about the liabilities part of the balance sheet, which is one of the ways a company raises resources. In this video, we will discuss where a company gets the remaining part of these resources from, namely the shareholders' equity. We will discuss in detail the different components of shareholders' equity, namely preferred equity, common equity, treasury stock, and retained earnings. We will continue to use Amazon's balance sheet from December 2015 to better understand shareholders' equity. Shareholders' equity is also referred to as net worth. It represents the total equity interest of all the company's shareholders. It mainly includes preferred equity, common equity, treasury stock, and retained earnings. The most important form of equity is common equity. Shareholders having common equity have voting rights and hence are the company's owners. They have the right to select the board of directors, which then appoints the different CXOs who in turn manage the day-to-day operations of the company. At the end of 2015, Amazon had close to 500 million shares of common stock outstanding, each with a par value of $0.01. The value of these shares is 500 million times 0.01, which equals $5 million. When a company sells common shares to the shareholders, the shares are usually sold at a value higher than its par value. The company receives this premium in the form of cash, and hence it must be recorded on the balance sheet. This is recorded as additional paid-in capital. It is the premium over the par value that the company receives at the time of the sale of shares to the public. Amazon had additional paid-in capital of $13.39 billion at the end of 2015. Treasury stock represents common stock that a company buys back from common shareholders or were authorized but was never sold to shareholders. This is recorded at cost. Amazon had treasury stock worth $1.84 billion. This amount is deducted from the value of common shares outstanding, as they do not pay dividends, have no voting rights, and hence should not be included in shares outstanding calculations. The other form of equity is preferred stock. It is the investment in the company by preferred stockholders. They have priority over common stockholders, which means that the company must pay them dividends before it can pay any dividends to the common stockholders. However, preferred stockholders do not have any voting rights in the company. At the end of 2015, Amazon was authorized to issue 500 million shares of preferred stock, but it had not issued any preferred stock. So there is no value recorded against preferred equity on Amazon's balance sheet. The other important component of shareholders' equity on the balance sheet is retained earnings. This is an aggregate of undistributed profits across all years. The manager has discretion as to how much, if any, of the profits a company makes should be distributed to shareholders, both common and preferred, as dividends. Any part of the profits that is not paid out as dividends is added to the balance sheet as a part of retained earnings. Profits are computed on the income statement, which we will look at in greater detail later in the course. Amazon had retained earnings of $2.55 billion at the end of 2015. Amazon's shareholders' equity also includes other accumulated comprehensive loss for $0.72 billion. Its annual report states that this represents unrealized gains and losses from investments in cash, cash equivalents, and marketable securities. Adding all the different items under shareholders' equity, Amazon's total shareholders' equity was $13.38 billion. Adding this to its total liabilities of $52.06 billion gives us a total of $65.44 billion, which equals its total assets. So Amazon's uses of resources exactly matches its sources of resources. We have talked about the balance sheet in the last few videos. Next time we will start looking at the income statement. In the next few videos, we will look at the income statement in detail. We will continue to use Amazon's financial statements from its 2015 year-end annual report. In this video, we will define the income statement. We will also distinguish between expensing and capitalizing. Finally, we will talk about the first item on the income statement, namely revenues or sales. The income statement is also referred to as profit and loss statement. It reports a company's operating results for the period, which largely includes its revenues and costs. Amazon's annual report refers to the income statement as consolidated statements of operations. The income statement is of interest to analysts, investors, and potential investors as it tells them how profitable a company is. In a nutshell, a company's net income, which is also called profit or loss, is its revenues minus all expenses. We will look in greater detail at what constitutes these revenues and expenses. Before we start looking at the various items on the income statement, we will discuss the difference between expensing and capitalizing. Assets and expenses are two sides of the same coin. Both require the use of a company's resources. However, if the benefits of the use of these resources result in the same period as the use itself, then the use is categorized as an expense. The entire amount used appears on that period's income statement. However, if the benefits of the use are expected to accrue in future time periods when compared to when the resources are used, then the use is capitalized. This means that the entire amount used is shown as an asset on the balance sheet. Examples of such capitalized expenditures are plant, property and equipment, PP&E, purchased patents and trademarks. The capitalized expenditures are eventually charged as expenses to the income statement through two different processes. One is amortization, two is impairment. Amortization is the process of allocating an asset's value to those future periods when its benefits are expected to be earned, typically over the asset's useful life. For example, if an asset's useful life is 5 years, then 1/5 of the asset's value will be charged as an expense during each of those 5 years. The most common example of amortization is depreciation, which is terminology used for amortizing plant, property and equipment. In certain circumstances, market forces or nature may destroy substantial parts of an asset's value. In such a case, we write down the value of the asset to its current fair value, that is, its market value, through a process of impairment. The amount of impairment is charged as an expense during the period when the value destruction occurs. Note that amortization is a periodic charge that occurs every period over the asset's life, while impairment is a one-time event. Moving on to the income statement, its first item is revenue or sales. It is also called the top line as its first item on the income statement. Revenues include only income from the company's primary lines of business or operations. It excludes income from other sources like investments. These will be reported later in the income statement. Looking at Amazon's income statement at the end of 2015, it had net product sales of $76.27 billion and net service sales of $27.74 billion. Net means that these revenues are net of any returns and net of any discounts offered to customers. Amazon's annual report states that net product sales are those realized from selling its own inventory. Net service sales are largely Amazon's share of revenue of items sold by third-party sellers. Taken together, Amazon's net sales revenues for 2015 was $107.01 billion. Next time, we will start looking at the various expenses a company incurs in generating these revenues. In this video, we will look at some of the common expenses a company incurs while generating revenues. Specifically, we will look at what cost of goods sold is and the different types of operating expenses. We will also present some of the intermediate profit measures calculated on the income statement. The first expense is cost of goods sold, referred to as COGS, C-O-G-S. This refers to the direct costs a company incurs in generating a warehouse full of goods or products ready to be sold. This includes raw material costs and direct labor costs that go into the production of the final product. It does not include any distribution costs or sales force costs. Amazon reports COGS as cost of sales. It had $17.65 billion in cost of sales in 2015. The annual report notes that this includes the purchase price of consumer products, digital media content, packaging supplies, sortation and delivery centers, and related equipment costs, and inbound and outbound shipping costs. In summary, it includes all costs Amazon incurs in delivering its products to its customers. The first profit measure is the gross profit. This is the difference between the company's revenues and its COGS. It tells us how much a company makes in profits after deducting the costs directly associated with producing and selling its product or the costs directly associated with providing services. Amazon's net sales in 2015 were $107.01 billion and its COGS were $71.65 billion. Deducting COGS from its net sales, Amazon's gross profits or gross income for 2015 were $35.36 billion. Next, the income statement contains various operating expenses which are deducted from the company's gross profits. The major component of operating expenses is selling, general and administrative expenses, referred to as SG&A. This is a non-production cost and typically includes all selling expenses related to selling the company's products like advertising expenses, rent and salaries of the sales force. All executive salaries and costs of general support are also part of SG&A. Finally, any general operating expenses are also included in SG&A. Another key component of SG&A is depreciation and amortization expense. Remember, we talked about expensing and capitalization last time. Depreciation and amortization expense occurs when the cost of acquiring an asset is capitalized because the benefits from this asset are realized over a number of years rather than only in 1 year it was acquired. The number of years over which the cost of the asset is spread over is referred to as its useful life. However, one thing to note here is that unlike other expenses on the income statement, depreciation and amortization expense is not an amount that is paid out to someone. Hence, the depreciation and amortization expense is a non-cash expense. Depreciation is the expense related to PP&E and other fixed assets, whereas amortization is the expense related to intangible assets like goodwill, trademarks, brand names, etc. On Amazon's income statement, SG&A consists of fulfillment, marketing, and general and administrative expenses. Its annual report states that fulfillment primarily includes costs Amazon incurs in operating and staffing its fulfillment and customer service centers, as well as its payment processing centers. For 2015, this was $13.41 billion for Amazon. Marketing expenses are costs incurred by a company in marketing and selling its products and services. Amazon incurred marketing expenses of $5.25 billion in 2015. The last part of SG&A is general and administrative expenses. This includes payroll expenses, professional and litigation expenses, other corporate costs, as well as depreciation expenses. Amazon's general and administrative expenses for 2015 were $1.75 billion. This gives Amazon's total SG&A for 2015 to be $20.41 billion. However, one thing to note is that Amazon's income statement does not state its depreciation and amortization expense separately. It is implicitly captured under the different components of SG&A. Amazon's statement of cash flows reports its depreciation and amortization expenses to be $6.28 billion for 2015. Companies incur costs on research and development in developing new products and services. This appears as technology expenses on Amazon's income statement for 2015. Amazon's annual report states that technology costs include payroll and related costs for employees involved in application, production, maintenance, operation, and platform development, as well as technology infrastructure expenses. Amazon also incurred content costs, which include payroll and related expenses for employees involved in category expansion, editorial content, buying, and merchandising selection. These technology and content costs total $12.54 billion for Amazon in 2015. Once we add in the technology and content costs and other operation expenses of $0.17 billion to SG&A of $20.41 billion, Amazon's total operating expenses for 2015 were $33.12 billion. Subtracting these operating expenses from Amazon's gross profit of $35.36 billion gives us Amazon's operating profit in 2015 to be $2.24 billion. Operating profit is also referred to earnings before interest and taxes. These are the company's profits before any interest and taxes are paid. Another commonly mentioned profit measure is EBITDA, which stands for earnings before interest, taxes, depreciation and amortization. To get this, we will simply add depreciation and amortization expenses to EBIT. For Amazon, EBITDA in 2015 was $2.24 billion plus $6.24 billion, which gives us $8.48 billion. This is a relevant number as depreciation and amortization expense is a non-cash expense. Hence, this is a more relevant number in terms of profits made by the company. Next time, we will look at the remaining part of the income statement and a few other profit measures. Last time we started looking at the different components of the income statement. We covered items like EBITDA and EBIT. In this video, we will complete the remaining items on the income statement and also define a few other profit measures that we would typically observe on an income statement. We will also cover how the income statement and balance sheet are linked. We calculated Amazon's EBITDA to be $8.48 billion at the end of 2015 and its EBIT to be $2.24 billion. The next step is to adjust for any interest income and expenses. Remember, at the top of the income statement, only revenues from operations are reported. But a company earns an income from investing some of their capital in short to medium term investments that pay an interest periodically. This is recorded as interest income and is added to the company's EBIT. For Amazon, interest income in 2015 was $0.05 billion. Similarly, a company pays interest on monies borrowed from various sources. This is deducted from EBIT. Amazon had an interest expense of $0.46 billion in 2015. It also incurred other non-operating expenses of $0.26 billion in 2015. Adding the interest income of $0.05 billion to and subtracting the interest expense of $0.46 billion and other non-operating expenses of $0.26 billion from the EBIT of $2.24 billion gives us Amazon's earnings before tax, referred to as EBT, to be $1.57 billion. Another expense on the income statement are those that are unusual or infrequent. Until recently, they were recognized as extraordinary items on the income statement. After a recent rule change, they do not have to be recognized separately as extraordinary items, but still have to be reported as revenue or expense, as the case may be, on the income statement. An example of an extraordinary event is loss of inventory because of a fire in the warehouse. This would be reported as losses due to the fire in the warehouse on the income statement. In 2015, Amazon did not have any such extraordinary items. The last part of the income statement is corporate taxes that the company must pay. This depends on what the tax rate for the company is. Total tax obligations for Amazon in 2015 were $0.95 billion. After subtracting these taxes and net equity method of investment activity of $0.02 billion, Amazon's net income or earnings after tax or profit after tax was $0.60 billion. The net income is also referred to as the bottom line, as it is the last line in the income statement. It represents the profits net of all expenses incurred during the year. The net income represents the total profits of the company. The income statement usually also reports an earnings per share, referred to as EPS. The EPS tells us how much profit the company has made for every share in the company. There are two types of EPS usually reported on the income statement: basic and diluted EPS. Basic EPS is based on the number of shares the company has actually sold. Amazon's income statement states that it uses 467 million shares outstanding to compute the basic EPS. Dividing the net income of $0.60 billion by the 467 million shares outstanding gives us a basic EPS of $1.28 per share. A company makes a number of stock awards. For example, a company includes employee stock options as part of its employees' compensation. These allow employees to buy the company's shares at a later date. Diluted EPS is computed as if the impact of such purchases by employees is included in the number of shares outstanding. Amazon's income statement reports that the number of shares outstanding used to compute a diluted EPS is $477 million. This means that Amazon has stock awards for 10 million shares that are yet to be converted to stocks. Dividing the net income of $0.60 billion by 477 million shares yields a diluted EPS of $1.25 per share. An investor would prefer that the difference between basic and diluted EPS not be very large. If the difference is very large, it signifies that there may be a potentially large dilution in ownership stake in the future. A smaller difference signifies that the dilution in ownership stake may not be very large. Lastly, we look at how a company's net income is reported on the balance sheet. Common shareholders are the owners of the company but are also the last claimants to a company's profits. They are referred to as residual claimants. The EPS represents what shareholders could potentially get. In Amazon's case, the basic EPS of $1.28 per share says that each shareholder is eligible to earn $1.28 for every share she owns. However, in most cases, a company will not pay its entire EPS to shareholders as it may want to retain some of its earnings for future investments. In fact, a number of high-tech companies do not pay any dividends at all as they prefer to retain profits for future investments. Amazon is one such company. In case the company pays any dividends, the difference between its net income and the dividends paid out to shareholders is referred to as retained earnings. This retained earnings is aggregated or accumulated on the balance sheet every year under shareholders' equity. As a company makes profits every year and retains at least some of its earnings, shareholders' equity will keep growing on the balance sheet. This brings us to the end of the income statement. Next time, we will start looking at the statement of cash flows and how it is different from the income statement. In this video, we will start discussing the statement of cash flows. We will start by discussing the need for it and how it is different from the income statement. We will list the three main parts of the statement of cash flows. We will also discuss how to calculate cash flows from operating activities, which is the first part of the statement of cash flows. The balance sheet tracks the change in a company's cash balance from one year to the next. However, it does not tell us why the cash balance changes. For example, Amazon had cash and cash equivalents worth $14.58 billion at the end of 2014 and cash and cash equivalents worth $15.89 billion at the end of 2015. What caused the increase of $1.31 billion in Amazon's cash and cash equivalents? The income statement does not track changes to cash as everything is recorded on an accrual basis. Remember, accrual basis means a transaction is recorded on the income statement as soon as an economic event occurs, regardless of when the cash from this economic event is actually received or paid by the company. Profits or net income cannot pay a company's bills because it does not represent cash. To that end, the income statement is not very helpful in tracking why cash and cash equivalents change every year. The statement of cash flows reports the different channels through which changes in cash during the year may be attributed to. This helps in determining the ability of a company to pay its suppliers, pay its employees, make interest and dividend payments, repay loans, buy PP&E needed for expansion, etc. The statement of cash flows separates the change in cash and cash equivalents from the beginning to the end of the year into three categories, namely cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. Cash flows from operating activities are those related to the company's operations-related current assets and current liabilities. Cash flows from investing activities are those related to the company's non-current assets. Cash flows from financing activities are those related to the company's non-current liabilities and shareholders' equity. Let us first focus on determining the cash flows from operating activities. There are two ways to do this. One is through the direct method and the other is through the indirect method. Under the direct method of calculating cash flows from operations, cash inflows and outflows are directly reported. This method is simple and easy to understand. However, it is very costly for companies to maintain this method as they have to maintain very detailed cash records. Under the indirect method of calculating cash flows from operating activities, adjustments to net income are made to reflect only cash receipts and disbursements. This is because net income is calculated following accrual principles and not on cash basis. The adjustments to net income typically fall into two categories. One is adjusting for items that affect net income but not cash. Example of such items are depreciation and amortization expenses and credit sales. These are recognized on the income statement, though no cash has been paid or received for these. The second adjustment is for items that affect cash but not net income. An example of this is raw materials and supplies that a company has purchased with cash but has not sold as yet. This is not reflected on the income statement until the inventory is sold, but the cash paid to buy it is not recognized on the income statement. In this course, we will use the indirect method of determining cash flows from operating activities, as companies use this when they report their statement of cash flows in the annual report. We will look at how to compute Amazon's cash flow from operating activities next time. Last time we started looking at the statement of cash flows and briefly about its cash flows from operating activities section. In this video, we will look at all the adjustments that need to be made to compute a company's cash flows from operating activities. These include adjusting for non-cash expenses, expenses related to investing and financing activities, as well as cash flows related to current assets and current liabilities. Let's start looking at Amazon's cash flow from operating activities for 2015. While there are a number of items on its statement of cash flows, we will only discuss the most common and important of these adjustments. The first item is Amazon's net income of $0.60 billion. To this, we make adjustments for various items. The first set of adjustments are for non-cash expenditures as well as expenditures related to investing and financing activities. These adjustments eliminate the impact of these items on the company's cash balance. Cash-based investing and financing expenses will be adjusted for later in the cash flow from investing and financing activities sections, respectively, of the statement of cash flows. The first major adjustment is for depreciation and amortization expenses, which are non-cash expenses. This means that while they are deducted from revenues when calculating profits, this expense is not paid or owed to anyone. To this extent, the net income understates the amount of cash a company has. So the depreciation and amortization expense will have to be added back in full to the net income while making adjustments. These non-cash expenses were $6.28 billion for Amazon. The next adjustment is for non-cash based salaries. All executive and employee salaries are recorded under SG&A and deducted from revenues. However, not all salaries will be paid in cash. Part of it may include stock-based compensation. While this compensation is recognized as an expense on the income statement, this again is cash not paid to employees. The net income again understates the cash on hand. In 2015, Amazon had stock-based compensation worth $2.12 billion, which is added back in full. Some of a company's operating expenses may not have been in cash, and so again the net income understates how much cash a company has. This amount must also be added back in full to the net income. Amazon's statement of cash flows reports this number to be $0.16 billion. A company may earn income from interest and other sources and may also incur other types of costs, none of which are related to its operations. The impact of these non-cash items must be removed from the net income. Amazon had $0.25 billion in such expenses, net of any income. This figure should be added back to net income as they are not related to operations. Had any non-operating income been greater than any non-operating expenses, the number would have to be subtracted from net income as the income net of expenses are not related to operations. The other major adjustment to net income for non-cash expenses is any deferred income taxes. The income statement reports how much tax a company should pay. However, at times, depending on tax laws, not all taxes may be paid off. Some of it may be deferred to the future. So deducting the entire tax due from revenues underreports how much cash a company has. Any deferred taxes will have to be added to net income. Amazon had $0.08 billion in deferred taxes, which is added back to net income. There are a few more non-operations related adjustments to Amazon's net income. These include an addition of $0.01 billion in losses incurred by Amazon during the sale of marketable securities and the deduction of $0.12 billion for excess tax benefits from stock-based compensation. We will not discuss these in detail. So the total adjustments to net income are $6.28 billion for depreciation and amortization, $2.12 billion for stock-based compensation, $0.16 billion for net operating expenses, $0.25 billion for non-operating expenses, $0.08 billion for deferred taxes, $0.01 billion for losses during the sale of marketable securities, and finally a negative $0.12 billion for excess tax benefits from stock-based compensations. These adjustments add up to a positive $8.78 billion. The next set of adjustments is operations related. These largely include adjustments due to changes to the firm's operations related current assets and current liabilities. Amazon's inventories increased by $2.19 billion between 2014 and 2015. This tells us how much the company has spent on purchasing raw materials and supplies, but this is not recorded on the income statement until the inventory is sold. In other words, it tells us how much cash the company has tied up in inventory. Consequently, the net income overstates how much cash a company has at the end of the year, and any increase must be deducted from net income. If inventory had not changed between the consecutive years, then no inventory related adjustment is necessary because the company has not invested more cash in inventory. On the other hand, if inventory had decreased, the company would have converted inventory to cash and the cash on hand would have increased by the amount of inventory sold. Decreases in inventory must be added to the net income. The same argument holds for all other types of operations related current assets. For example, if accounts receivable increases, it denotes that the company has not received cash for at least some of its sales. So the revenue and the net income overstate how much cash the company has. Amazon saw an increase of $1.76 billion in its accounts receivables between 2014 and 2015. This increase is subtracted from net income on the statement of cash flows. The reverse is true for changes to operations related current liabilities. That is, increases in current liabilities must be added to net income and decreases must be subtracted from net income. For example, an increase in accounts payable tells us that the company still has not paid some of its suppliers for products and services that the suppliers have already provided. However, the cost of these products and services are subtracted from revenues while calculating net income. So the net income understates how much cash a company has when accounts payable increases. Amazon's accounts payable increased by $4.29 billion between 2014 and 2015, and this is added to net income. Similarly, accrued expenses also increased between 2014 and 2015. These are expenses deducted from revenues on the income statement but still not paid. So these also need to be added to net income on the statement of cash flows. Amazon's accrued expenses increased by $0.91 billion between 2014 and 2015. Some clients and customers may also pay a company in advance for its products and services. These are recorded as unearned revenues on the balance sheet but are reported on the income statement only when the company delivers its products and services. But this is additional cash in hand, and hence any increases in unearned revenue should also be added to net income. Amazon's unearned revenues increased by $7.40 billion between 2014 and 2015, and this is added to net income. Amazon has an additional cash adjustment of negative $6.11 billion to its net income in 2015. To summarize, Amazon had the following operations-related current assets and current liabilities: a deduction of $2.19 billion for increase in inventories, a deduction of $1.76 billion for increase in accounts receivable, an addition of $4.29 billion for increase in accounts payable, an addition of $0.91 billion for increase in accrued expenses, an addition of $7.40 billion for increase in unearned revenues, and finally a deduction of $6.11 billion for amortization of previously unearned revenues. This adds up to a total of $2.54 billion. Adding this to the net income of $0.60 billion and the earlier adjustments for non-cash expenses and non-operations related expenses of $8.78 billion gives Amazon a net cash flow from operating activities of $11.92 billion during 2015. Next time, we will look at the remaining parts of the statement of cash flows and reconcile the changes in cash from it with the changes in cash and cash equivalents on the balance sheet. Last time we saw what adjustments to do to determine a company's cash flows from operating activities. We calculated Amazon's cash flows from operating activities to be $11.92 billion in 2015. In this video, we will compute the cash flows from both investing as well as financing activities and then reconcile them with the change in cash on the balance sheet. The next part of the statement of cash flows is the cash flows from investing activities. This part includes all ways in which a company invests its cash in assets, both current as well as non-current. These investments are not reported on the income statement but represent actual cash paid or received. Like we saw for operations-related current assets, any increase in investment assets will mean that the company has spent cash to buy these assets and will result in a reduction in cash. Conversely, any sale of assets will result in an increase in cash. In 2015, Amazon bought property and equipment worth $4.59 billion, which means that cash on hand reduced by this amount. Amazon also made some acquisitions worth $0.80 billion, which also reduced cash on hand. Changes in investing related current assets also need to be adjusted for. The main item here is the purchase, maturity, and sale of any marketable securities. Any net purchases would mean cash was spent and would be deducted. Any net sales would mean cash was received and would be added. Amazon received a total of $3.03 billion in cash from the maturity and sale of marketable securities. On the other hand, it purchased $4.09 billion worth of marketable securities. Summarizing all the cash flows related to investing activities, we have a deduction of $4.59 billion in purchases of property and equipment, a deduction of $0.80 billion for acquisitions during the year, an addition of $3.03 billion from the sale and maturity of marketable securities, and a deduction of $4.09 billion for the purchase of marketable securities. These add up to a negative $6.45 billion. Amazon's investing activities in 2015 resulted in a reduction of $6.45 billion in cash. The next part of the statement of cash flows is the cash flows from financing activities. These relate to the increase and decrease in non-current liabilities as well as financing related current liabilities. Similar to what we saw for adjustments for change in current liabilities, any increase in financing activities would result in an increase in cash, and any decrease in financing activities would result in a decrease in cash. An increase in financing activities means that the company has raised additional capital from various sources, and so it has more cash on hand. Conversely, a decrease would mean that the company has paid back some of its investors, which means that the amount of cash on hand decreases. Under cash flow from operating activities, we had subtracted $0.12 billion on account of excess tax benefits from stock-based compensation, stating that this was not an operations-related cash flow. We add that amount back here as it is related to the company's stock, which is one of the channels of raising finance, and this is a real cash saving for the company. In 2015, Amazon raised an additional $0.35 billion in long-term debt, but also repaid $1.65 billion worth of long-term debt. It also repaid principal on capital and finance lease obligations worth $2.46 billion and $0.12 billion respectively. Since these are cash outflows, they are deducted. None of these changes are reported on the income statement, which is why we are making these adjustments to cash on the statement of cash flows. Adding Amazon's different items under cash flows from financing activities gives us a negative $3.76 billion. This means that Amazon used up a total of $3.76 billion to repay some of its obligations. Amazon's statement of cash flows also reports a foreign currency effect on cash and cash equivalents of $0.37 billion, which is deducted. Summarizing the cash flows from different activities, we have a positive $11.92 billion from operations, a negative $6.45 billion from investing, and a negative $3.76 billion from financing, plus a foreign currency adjustment worth a negative $0.37 billion. Adding these up, Amazon's change in cash and cash equivalents during 2015 was $1.33 billion. Amazon had cash and cash equivalents worth $14.56 billion at the beginning of 2015. Adding the change in cash and cash equivalents of $1.33 billion to this beginning of year balance gives us an end of 2015 cash and cash equivalent balance of $15.89 billion, which is what is reported as cash and cash equivalents in Amazon's 2015 balance sheet. Hence, using the statement of cash flows, we have reconciled the change in cash and cash equivalents from the beginning to the end of 2015. The statement of cash flows has given us a better idea as to where cash is generated from and where cash is used. In Amazon's case, its operating activities have generated cash, while its investing and financing activities have consumed cash. In the last few videos, we have seen the different financial statements that companies report publicly as well as their different components. But what do these financial statements tell us about the company's financial health? We can analyze a company's financial health by examining financial ratios, which are calculating using data from financial statement. We will start looking at these next time. How do we determine if the company is doing well financially or not? We saw that Amazon had a net income of $0.60 billion at the end of 2015. Is that good or bad? To answer this question, we will look at a number of financial ratios. In this video, we will introduce the idea of financial statement analysis. We will also talk about the different tools used in financial statement analysis as well as the approaches used with each tool. We will wrap up this video by defining the 5 most common categories of financial ratios. Financial statement analysis is a comprehensive analysis of a company's strategy, its competition, regulations and taxes that affect it, its past, current and financial performance, the fundamental valuation of a company relative to its stock price, and planning for the company's future operations, investments and finances. In this course, we will focus only on financial performance and fundamental valuation relative to stock price. The typical tools used in financial statement analysis are comparative analysis, common size analysis, and ratio analysis. Comparative analysis is the evaluation of consecutive financial statements of a company to identify the direction, speed, and magnitude of any trends in financial performance. Common size analysis is the evaluation of the internal makeup of financial statements and/or financial statement items across companies. For example, this could mean that a common size income statement would report all income statement items as a percentage of revenues. This is especially useful when you compare two companies that have widely different revenues. Similarly, all balance sheet items could be reported as a percentage of total assets. Ratio analysis evaluates the relationship between two or more economically important items. For this, prior accounting analysis is important and interpretation is very important. We will focus mostly on ratio analysis. The approaches used with each of these tools are as follows: time series analysis, cross-sectional analysis, and benchmark comparison. Time series analysis is the comparison of a firm with itself over time. Cross-sectional analysis is the comparison of different companies in an industry at a given point in time. Benchmark comparison is the use of pre-specified industry norms or benchmarks. In this course, we will mostly focus only on time series analysis. Financial ratios largely fall into 5 different categories, namely profitability ratios, activity ratios, solvency ratios, liquidity ratios, and valuation ratios. Profitability ratios measure a company's ability to generate profits from its various resources. Activity ratios measure a company's ability to convert various assets and liabilities into cash or sales. Solvency ratios measure if a company has sufficient cash to meet its long-term financial commitments. Liquidity ratios, on the other hand, measure if a company has enough cash to meet its short-term financial obligations. Finally, valuation ratios compare the current market price of a company's stock to certain items from the financial statements. Next time, we will start looking at the various types of ratios within each category of financial ratios. In this video, we will look at some of the common profitability ratios like return on equity, return on assets, gross profit margin, operating profit margin, net profit margin, etc. We will continue to use Amazon's financial statements to compute these financial ratios. The first couple of profitability ratios measure how well a company has used its balance sheet resources to generate profits. These two ratios are return on equity, ROE, and return on assets, ROA. ROE is defined as the net income divided by the average shareholders' equity. The denominator is the average over 2 consecutive years. For 2015, we will average shareholders' equity from 2014 and 2015 balance sheets. The reason we average over 2 consecutive years is that this number will change at least a few times in a year. So we don't know the exact level of shareholders' equity on each day during the year as profits are generated. In most cases, when we have one balance sheet item and one income statement item as a part of a ratio, we will use this method of averaging for the balance sheet item. To calculate Amazon's ROE for 2015, we know that its net income for 2015 was $0.60 billion. Its average shareholders' equity for 2015 was $12.06 billion. Dividing 0.60 billion by 12.06 billion, we get an ROE of 0.0494, or multiplying it by 100, we get 4.94%. For every dollar of shareholders' equity, Amazon earned a little less than 5 cents in profits. Similar calculations yield ROEs of negative 2.35%, positive 3.05%, and negative 0.49% respectively for 2014, 13, and 12. This shows that Amazon's profitability has not been very stable over the last few years and that it has been at its most profitable in 2015. The next profitability ratio is ROA. It is defined as the company's net income divided by its average total assets. Average total assets are defined much like average shareholders' equity for ROE. In 2015, Amazon's net income was $0.60 billion and its average total assets was $59.97 billion. Dividing the net income by its average total assets, Amazon's ROA for 2015 comes out to be 0.99%. For every $1 in total assets owned by Amazon in 2015, it generated profits of less than 1 cent. But similar to ROE, 2015 was the most profitable year for Amazon over the last 4 years, but its profitability changes quite dramatically every year. The other types of profitability ratios are all based on only income statement items. These give us an idea as to how well the company is managing its costs and hence maintaining its profitability. The first of these ratios is the gross profit margin, or simply gross margin. The gross margin is the ratio of the company's gross profit for the year divided by its revenues for the year. Gross profit is the difference between revenues and COGS. The gross margin tells us how well a company has managed its manufacturing costs or direct costs incurred in the delivery of its products or services. A company would like the gross margin to be high. In 2015, Amazon had revenues worth $107.01 billion and COGS worth $71.65 billion. Its gross profit was $35.36 billion, which when divided by its revenues and expressed as a percentage by multiplying it by 100, yields a gross margin of 33.04%. Comparing Amazon's gross margin over the past 4 years, you can see that it has consistently increased every year since 2012. Looking at its revenues and COGS, both have increased over the last 4 years, but revenues have increased at a faster rate than COGS, leading to an increase in gross margins over time. The next profitability ratio is the operating profit margin, which is defined as the operating profit divided by revenue. Operating profit is also known as EBIT. Amazon's EBIT in 2015 was $2.23 billion and its revenue was $107.01 billion. This gives us an operating profit margin of 2.09%, which is again the highest in the last 4 years. The fifth profitability ratio is the pre-tax margin, which is the earnings before taxes divided by revenues. Amazon's earnings before taxes in 2015 were $1.57 billion. Dividing this by its revenues of $107.01 billion gives the pre-tax margin to be 1.47%. Yet again, this is the highest in the last 4 years. The final profitability ratio we look at is the net profit margin, or simply net margin. It is the net income divided by revenues. Amazon's net income in 2015 was $0.60 billion. Dividing this by its revenues of $107.01 billion gives Amazon's net profit margin to be 0.56%, again the highest in the last 4 years. Based on all the profitability ratios, it appears that Amazon is doing well in the most recent year compared to its recent past. Though its gross margin is 33.04%, its net margin is only 0.56%. Amazon's COGS is 2/3 of all its revenues, whereas its other expenses account for almost all of the remaining 1/3. To get a better sense of whether these ratios are too high or low, Amazon's ratios should be compared to those of its competitors. I will let you try this on your own. In the next video, we will look at some of the more popular activity ratios. Last time we saw a number of profitability ratios. In this video, we will look at some of the common activity ratios like total asset turnover, fixed asset turnover, working capital turnover, days receivables outstanding, days inventory held, days payables outstanding, and cash conversion cycle. Activity ratios measure a company's ability to convert assets and liabilities into cash or sales. The faster it is able to do this, the more efficiently it is run. The first activity ratio is the total asset turnover. It measures how efficiently a company uses all its assets to generate revenues. It is defined as revenues divided by average total assets. Amazon's revenues in 2015 were $107.01 billion and its average total assets were $59.97 billion. This gives its total asset turnover to be 1.78. Every dollar in total assets generated $1.78 in revenues. This ratio has worsened for Amazon over the last 4 years as it was over 2 in 2012. However, the drop in total asset turnover may be indicative of Amazon investing in more assets with an eye towards future growth. These long-term investments in assets may reduce total asset turnover in the short term. The average total assets have actually doubled over the last 4 years, and so the decrease in total asset turnover may not be indicative of Amazon's worsening efficiency. The next activity ratio is the fixed asset turnover. This is similar to the total asset turnover, but specifically measures how efficiently a company uses its fixed assets to generate revenues. Amazon's fixed assets include investments in PP&E, goodwill, and other intangible assets. Its average fixed assets in 2015 were $22.94 billion. Dividing its revenues of $107.01 billion by $22.94 billion gives us a fixed asset turnover of 4.66. For every $1 invested in fixed assets, Amazon generates $4.66 in revenues. Similar to total fixed turnover, Amazon's fixed asset turnover has decreased over the last 4 years. This again is not necessarily bad as its fixed assets have almost tripled in 4 years. Amazon may have invested more in fixed assets with a focus on future growth. The remaining activity ratios are all related to a company's current assets and liabilities, the first of which is working capital turnover. It is defined as the ratio of revenues to average working capital. Working capital measures a company's operating liquidity. It tells us if the company has sufficient operations-related current assets to pay off its operations-related current liabilities. It is calculated as accounts receivables plus turnover minus accounts payable. Working capital turnover indicates a company's effectiveness in using its working capital, that is, does it generate enough revenues using its working capital. Amazon's average working capital in 2015 was a negative $3.14 billion. Given its revenues of $107.01 billion in 2015, Amazon has a working capital turnover of negative 34.08. A negative working capital turnover is quite meaningless other than saying that its current liabilities exceed its current assets. The working capital turnover is consistently negative over the last 4 years. So it is impossible to interpret whether Amazon has been efficiently using its working capital to generate revenues. Next, we look at the receivables turnover and days receivables outstanding. Receivables turnover measures how soon sales will become cash. It is defined as revenues divided by average receivables. In 2015, Amazon had average receivables of $6.02 billion. Dividing its revenues of $107.01 billion by the average receivables gives us a receivables turnover of 17.78. This says that Amazon converts its revenues to cash 17.78 times a year. Dividing 365 by the receivables turnover gives us a days receivable outstanding of 20.53 days. That is, Amazon converts its revenues to cash every 20.53 days. Days receivable outstanding is also called days sales outstanding. Days receivable outstanding has increased marginally from 17.73 days in 2012. This may be indicative of some of Amazon's customers having financial difficulties and hence delay in their payments. It could also be that Amazon's credit department is doing a poor job of recovering amounts due to it. The next pair of activity ratios are also related to current assets, specifically inventory. Inventory turnover measures how soon a company's inventory is being sold. It is defined as the ratio of COGS to average inventory. In 2015, Amazon had COGS of $71.65 billion and average inventories of $9.27 billion. Dividing COGS by average inventory gives us an inventory turnover of 7.73. This means that Amazon turns over its inventory 7.73 times a year. Dividing 365 by the inventory turnover gives us a days inventory held of 47.23 days. Amazon sells its inventory every 47.23 days. The days inventory held also has increased slightly over the last 4 years. This could be indicative of company losing some sales but nothing too dramatic. This is further supported by the fact that its inventory levels have doubled over the last 4 years. An alternate explanation could be that Amazon is planning a large sale and is building up its inventory for this reason. Finally, we look at how quickly a company pays its suppliers. This is measured using payables turnover and days payable outstanding. Payables turnover is the ratio of a company's purchases to average accounts payable. Purchases are defined as the change in inventory over the year plus the COGS for the year. In 2015, Amazon's inventory increased by $1.94 billion and its COGS was $71.65 billion. Adding the two, Amazon's purchases in 2015 was $73.59 billion. Dividing this by its average accounts payable of $18.43 billion gives us payables turnover of 3.99. Dividing 365 by the payables turnover of 3.99 gives us days payable outstanding of 91.40. This says Amazon pays its suppliers 3.99 times a year or once every 91.4 days. The days payables outstanding has decreased marginally over the last 4 years. While this may mean that Amazon is paying its suppliers more quickly, it could also mean that either suppliers are not extending credit to Amazon or that some of the credit terms offered by its suppliers are too good for Amazon to pass up. One last measure of a company's activity is the cash conversion cycle. It is calculated by adding days receivable outstanding and days inventory held and subtracting days payable outstanding. It measures how quickly a company converts its current assets to cash. The lower the cash conversion cycle, the better job the company is doing in converting to cash. A negative number is even better as it denotes that a company does not pay for its inventories until it has sold its products or services. It means that the company is managing its working capital as efficiently as possible and has cash available for a number of other things all the time. Amazon's days receivables outstanding is 20.53, its days inventory held is 47.23, and its days payables outstanding is 91.40. Adding the first two and subtracting the third gives Amazon's cash conversion cycle to be a negative 23.64 days. Like we discussed earlier, a negative cash conversion cycle denotes that the company converts its receivable and inventories to cash before it has to pay its payables. However, Amazon's cash conversion cycle has increased over the last few years, and so it indicates that it isn't doing as well as it has been. This wraps up our discussion on activity ratios. Next time, we will discuss what solvency and liquidity ratios are and the different types of these ratios. In this video, we will define what solvency and liquidity ratios are and look at some of the different types of these ratios. We will continue to use Amazon's financial statements from 2015 to calculate these ratios and compare them to Amazon's ratios from prior years. Solvency ratios measure a company's ability to meet its interest and principal obligations on long-term debt as well as obligations on long-term leases. The first solvency ratio is the debt to equity ratio. This measures how much long-term debt a company has for each dollar of shareholders' equity capital raised. It is defined as the ratio of the sum of long-term debt and long-term capital leases to total shareholders' equity, all of which come from the balance sheet. Amazon's long-term debt in 2015 was $8.24 billion and its capital leases were $5.95 billion. Its total shareholders' equity was $13.38 billion. This gives us the debt to equity ratio to be 1.06 in 2015. That is, for every $1 raised through equity capital, Amazon raised $1.06 in long-term obligations. Over the last 4 years, this ratio has more than doubled. So there may be concern that Amazon has too much debt. But we will have to check the debt to equity ratios of Amazon's competitors. They may also have similar debt to equity ratios, and it may just be that Amazon didn't have as much debt as its competitors in the past and has finally caught up. Another measure that captures how much debt capital a company has is the total liabilities to total assets ratio. This is defined as the company's total liabilities divided by its total assets. Higher this ratio, more the obligations, both short and long term, a company has. Also, higher this ratio, the lower equity capital a company has. In 2015, Amazon had total liabilities of $52.06 billion and total assets of $65.44 billion, which gives us a total liabilities to total assets ratio of 0.80. For every $1 in assets that Amazon purchases, 80 cents comes from the various forms of liabilities. Only 20 cents comes from equity capital. This ratio has been fairly stable over the last 4 years. Given that the debt to equity ratio has risen over the same time, it is likely that Amazon has substituted short-term obligations with long-term obligations. One other solvency ratio is the interest coverage ratio, also called times interest earned. This is based on income statement items. It measures if a company has earned enough profits to make its interest payments. It is defined as the EBIT divided by interest expense. EBIT is the profit a company is left over with after taking care of all expenses except interest and taxes. Interest is paid from EBIT. In 2015, Amazon had an EBIT of $2.23 billion and interest expense of $0.46 billion. The interest coverage ratio works out to be 4.86, that is, its EBIT is 4.86 times its interest expense. The rule of thumb is that an interest coverage ratio of greater than 2 is good. Anything lower than that is of concern. Except 2014, Amazon has maintained a sufficiently high interest coverage ratio, though it has been on the decline. This could be because Amazon has been taking on more long-term obligations, which we discussed earlier. Moving on to liquidity ratios, they measure a company's ability to meet its short-term obligations. One liquidity ratio is the current ratio. It measures whether a company's current assets are sufficient to meet its current liabilities. It is defined as the ratio of its current assets to current liabilities. In 2015, Amazon had current assets worth $36.47 billion and current liabilities worth $33.90 billion, which gives us a current ratio of 1.08. For every $1 in current liabilities, Amazon had 1.08 in current assets. Higher this ratio, the better liquidity a company has. A current ratio of 2 or more is healthy, and anything lower may be cause for concern. Amazon's current ratio has been just slightly higher than 1 the last 4 years. However, that may not be of concern as it has a negative cash conversion cycle, which means that its current assets are converted to cash before its current liabilities become due. While the current ratio tells us how easily a company pays off its current liabilities, inventories cannot be used to pay any of these obligations. It may also be extremely difficult to convert inventory held to cash in short notice. In that sense, inventory is not very liquid, and so it may not be appropriate to include inventory as a part of current assets when calculating liquidity ratios. The quick ratio makes this adjustment. It ignores inventory as a current asset and is defined as current asset minus inventory divided by current liabilities. In 2015, Amazon's inventory was $10.24 billion. Its current assets and current liabilities were $36.47 billion and $33.90 billion respectively. Subtracting $10.24 billion from $36.47 billion and then dividing by $33.90 billion gives us a quick ratio of 0.77. For every $1 in current liabilities, Amazon has 77 cents in current assets excluding inventory. Amazon's quick ratio has been fairly stable over the last 4 years. A concern with the quick ratio is that accounts receivable is also not truly liquid because a company's ability to convert receivables to cash depends on when its customers or clients pay. The cash ratio fixes this problem by ignoring all types of current assets other than cash and cash equivalents. It is defined as cash and cash equivalents divided by current liabilities. Amazon had cash and cash equivalents worth $19.81 billion and current liabilities were $33.90 billion in 2015. Dividing the two, Amazon's cash ratio comes out to be 0.58. That is, for every $1 in short-term obligations due, Amazon has 58 cents in cash and cash equivalents. The cash ratio has held stable over the last few years and so doesn't seem to be of concern. This concludes all the financial statements based ratios. Next time, we will look at the DuPont identity, which help us identify why a company's ROE is too low or too high. It helps us identify where the company is doing well and where it is doing poorly. We will also look at one market price based financial ratio. In the last few videos, we have seen various types of financial ratios using information from the balance sheet and income statement. In this video, we will relate a company's return on equity to measures of profitability, activity, and solvency ratios. This will help us identify what the company is doing correctly and where it needs to improve. We will also talk about one stock market price based financial ratio. The DuPont identity gets its name from DuPont Corporation, which began using this idea from the 1920s. It relates a company's return on equity to various financial ratios. It is easy to see what these financial ratios are. We start off with return on equity, which is defined as net income divided by average shareholders' equity. Let's multiply and divide by both revenue and average total assets. Net income divided by revenue is net profit margin, which is a profitability ratio. Revenue divided by average total assets is total asset turnover, which is an activity ratio. Average total assets divided by average shareholders' equity is called the equity multiplier and is a measure of the company's solvency. High values of equity multiplier tell us that the company has high levels of debt and low levels of equity. We now have ROE equals net profit margin times total asset turnover times the equity multiplier. This helps us attribute a company's low or high ROE to various factors measured by the three financial ratios. Let's take a look at Amazon's ROE for 2015. Earlier we calculated it to be 4.94%. Its net profit margin was 0.56% and its total asset turnover was 1.78. Amazon's average shareholders' equity and average total assets were $12.06 billion and $59.97 billion respectively. Dividing 59.97 billion by $12.06 billion gives us Amazon's equity multiplier to be 4.97. You can verify that multiplying the net profit margin of 0.56%, the total asset turnover of 1.78, and the equity multiplier of 4.97 gives us the ROE of 4.94%. Amazon's ROE has improved over the last 4 years. But why is this? During this time, its net profit margin has increased, which tells us that Amazon is doing a better job of controlling its expenses, leading to higher profits. However, efficiency has decreased as its total asset turnover has decreased over the last few years. Another reason for its higher ROE is that its equity multiplier has increased, which means it has borrowed more debt capital than raising equity capital. Increasing borrowing is not necessarily good, as it increases the chance of a company not paying off the loans on time. The last part of financial statement analysis in this course is measuring a company's value from its financial statements relative to its current stock price. There are a number of such ratios, but we are going to talk only about the price to earnings PE ratio here. One way to calculate PE ratio is to use the EPS from the most recent income statement. The PE ratio is defined as the market price for the company's shares on the date of the income statement divided by the EPS. The PE ratio tells us how much investors are willing to pay for each dollar of profits the company makes. One way of interpreting the PE ratio is that it tells us what the future growth potential for the company is. Higher the ratio, larger is its future growth potential. However, very high ratios compared to its competitors or to the rest of the market is indicative of the stock price being too high. Let's calculate the PE ratio for Amazon. For this, we need Amazon's stock price as of December 31st, 2015. We get these prices from Yahoo Finance. It was $675.89 per share. We can calculate the PE ratio using both basic as well as diluted EPS. For simplicity, we will use the basic EPS of $1.28. Dividing the share price of $675.89 by the EPS of $1.28 gives us a PE ratio of 528.04. For each $1 in profits earned, investors are willing to pay $528.04. This could mean that investors place a very high value on Amazon's future growth potential. Alternatively, Amazon's stock price is far higher than what its fundamentals justify and should be sold. In 2 of the past 4 years, Amazon has had negative PE ratios. It is impossible to interpret a negative PE ratio, as it does not make any sense as to why investors would be willing to pay anything for a company that is making losses. This brings us to the end of the financial statements and analysis part of this course. Next time, we will start looking at one of the most important concepts in finance, namely the risk-return trade-off. Learning outcomes. After completing this video, you should be able to calculate the holding period return of a security, explain risk using standard deviation, calculate the expected return and risk of a security. Expected returns and risk. In this video, we will define what expected return and risk are and the relation between the two. Let's look at how you would calculate the return on an investment in a stock. Say you pay $50 to buy 1 share in a stock today. After a year, the stock price is $55. During the 1 year you hold the stock, it pays you a dividend of $1. So what return have you earned from holding the stock for a year? There are 2 parts. One is the income from the dividend, which is $1, and the other is the change in price from $50 to $55. You have earned a profit of $6 on an initial investment of $50, which means your holding period return over the 1 year is 6 divided by 50, which is 12%. We can write a general formula for holding period returns as follows: P sub 1 minus P sub 0 plus D sub 1 divided by P0. In this example, your ability to calculate the holding period return depends on knowing how much dividend you will be paid while you hold the stock, as well as what the stock price will be after a year. However, we almost never know what these future numbers will be. So all we can do is to estimate what the return over the next 1 year will be. The return, hence, is a random variable that is characterized by its possible outcomes and the probabilities associated with each outcome. We can then estimate an expected return of an investment using the possible outcomes and their probabilities. This expected return is what we use as the discount rate when we calculate present and future values. Now let's turn to risk. Most people think of risk as being a bad thing. They relate it to the likelihood of losing money. Risk is actually the uncertainty of outcomes, both good as well as bad. In the context of investments, risk is the uncertainty of future returns. This is usually measured using either the variance or standard deviation of returns. Larger the variance or standard deviation, larger is the risk. Now let's see how expected return and risk are related. You have $100 and two investment choices to make. The first investment will give you $105 guaranteed after 1 year. Since there is no uncertainty or risk in this payoff, this is what is called a risk-free or riskless investment. The second investment will pay you either $150 after 1 year with a 60% probability, or $80 after 1 year with a 40% probability. This investment is risky as your future payoff is uncertain. The question is, which investment should you invest in? To answer this question, we need to compute the expected return and risk of the two investments. For the first investment, the expected return is 105 minus 100 divided by 100, which is 5%. There is no uncertainty in the investment, and hence its risk is 0. For the second investment, we have to compute the expected return for both possible payoffs. When the future return is $150, the expected return is 150 minus 100 divided by 100, which is 50%. When the future payoff is $80, the expected return is 80 minus 100 divided by 100, which is a negative 20%. With this investment, now there is a 60% chance of a 50% return and a 40% chance of a negative 20% return. So its expected return is 0.6 times 50% plus 0.4 times minus 20%, which equals 22%. Clearly, the second investment seems more attractive given its higher expected return. However, what is its risk? Its variance is 0.6 times 0.5 minus 0.22 the whole squared plus 0.4 times negative 0.2 minus 0.22 the whole squared, which equals 0.1176. The standard deviation is simply the square root of variance. The square root of 0.1176 is 34.29%. The second investment has a return that is 17% higher, but also has a risk that is 34.29% higher. As an investor, is the additional 17% return appropriate for the 34.29% risk? The answer is that it depends on two things. One, the investor's attitude towards risk, which is the domain of utility theory. Two, models that help compare the risk and return of different investment choices. These models are called asset pricing models. We will answer the question as to which investment is better after we discuss utility theory. Next time, we will discuss the idea of diversification to get a better idea of what type of risk or risks determine expected returns. Last time we talked about the relationship between risk and return. In this video, we will talk about diversification and the two types of risks, namely diversifiable and systematic risk, and also whether both risks affect returns or not. Let's think about the risk of a company's stock. If the company succeeds, then its stockholders make a lot of money. On the other hand, if it fails, stockholders lose their money. If an investor puts all her wealth in one stock and the company fails, then she loses all her wealth. This makes investments in only one stock very risky. It is better to invest in more than one stock, as this helps spread the risk. Note, a combination or collection of stocks is referred to as a portfolio. In a portfolio, there may be some stocks that perform badly, but there are likely to be others that offset at least part of this bad performance. Conversely, the good performance of some stocks may be offset by the bad performance of other stocks in the portfolio. This tells us that the risk or uncertainty of a portfolio is likely to be far lower than the risk of a single stock. This is the idea of diversification. The figure that you see plots portfolio variance on the vertical axis against the number of stocks in the portfolio on the horizontal axis. Here, portfolio variance is a measure of risk. The blue curve captures the relationship between risk and the number of stocks in the portfolio and represents the total variance or risk of the portfolio. As you can see, increasing the number of stocks in the portfolio reduces its variance. This drop in risk with increasing number of stocks in the portfolio captures the idea of diversification. The part of risk that is eliminated by forming a large enough portfolio is called diversifiable risk. In the figure, it is the gap between the blue curve and the horizontal black line. This gap becomes negligible by the time there are 50 to 60 stocks in the portfolio. However, beyond 50 to 60 stocks in the portfolio, its risk cannot be reduced any further. That is, we cannot achieve any further diversification. The part of risk that cannot be eliminated any further with the addition of more stocks is referred to as systematic risk. In the figure, it is the gap between the horizontal black line and horizontal axis. If forming sufficiently large portfolios can eliminate diversifiable risk, investors should not expect to be compensated for holding diversifiable risk. Let's look at a simple example to illustrate this. Say there are 4 stocks A, B, C and D and a risk-free bond. The risk-free rate is 5% per year. Stock A is expected to give a return of 12% over the next 1 year. Similarly, stocks B, C and D are expected to give returns of 15, 17 and 20% respectively over the next 1 year. Further, let's assume that none of the 4 stocks have any systematic risk. This means that A's additional 7% return over and above the risk-free rate is compensation only for its diversifiable risk. The same can be said about the other 3 stocks, that is, all 4 stocks compensate investors only for holding diversifiable risk. Given that D offers the largest compensation above risk-free rate and A the least, D has the largest amount of diversifiable risk and A has the least amount. Now let's form a portfolio with $100 and put $25 in each of the 4 stocks. So 25% of our wealth is in each of the stocks. Let's assume that the resultant portfolio has no diversifiable risk. In other words, we are able to completely diversify away our risk by forming this portfolio. Further, since none of the stocks had any systematic risk to begin with, this portfolio will also have no systematic risk. Consequently, this portfolio has absolutely no risk, that is, it is a risk-free asset. This means that it should also have a 5% expected return, the same as the risk-free asset. The expected return of a portfolio is a weighted average of the individual stocks' returns. Here it is 0.25 times 12% plus 0.25 times 15% plus 0.25 times 17% plus 0.25 times 20%, which works out to be 16% per year. Clearly something is not right. The portfolio has zero risk but has a return of 16%, which is much higher than the risk-free rate. This gives rise to what is called an arbitrage opportunity, that is the ability to make guaranteed profits. Investors will borrow at the risk-free rate of 15% and invest in this portfolio and earn a guaranteed 16%. The buying of these stocks will put an upward pressure on the prices of the 4 stocks, consequently reducing their returns. This will happen until all stocks are expected to earn a 5% return. So investors expecting to be compensated for holding diversifiable risk is not sustainable in the long run. Hence, they will be compensated only for systematic risk, that is risk that is not diversifiable. Next time, we will start talking about how to measure systematic risk and the models that relate measures of systematic risk to expected returns. Learning outcomes. After watching this video, you will be able to write the capital asset pricing model, CAPM, explain market risk premium, discuss what type of risk beta measures. The CAPM. Last time, we saw the preliminaries necessary to understand the CAPM better. In this video, we will see the mathematical form of the CAPM. The CAPM is written as follows. The expected return of any risky asset I equals the risk-free rate of return plus the beta of the risky asset I times the difference between the expected return on the market portfolio and the risk-free rate. In notations, the expected return of the risky asset is denoted by E of R sub I. The risk-free rate of return is denoted by R sub F. The beta of the risky asset is denoted by beta sub I. And the expected return of the market portfolio is denoted by E of R sub M. We defined the market portfolio last time. Beta is the measure of risk in the CAPM. Later, we will discuss what type of risk it measures. In plain English, the CAPM says that the expected return of any risky asset over and above the risk-free rate of return equals the sensitivity of its return with respect to the market portfolio, which is denoted by beta, times the expected market risk premium. The expected market risk premium is the difference between the expected return on the market portfolio and the risk-free rate of return. It tells us how much return in excess of the risk-free rate of return an investor expects to earn from holding the market portfolio. In other words, what is an investor's compensation for holding the risk of the market portfolio? So what does beta measure? We had talked about diversifiable idiosyncratic risk and non-diversifiable systematic risk. The market portfolio is mean variance efficient. This says that idiosyncratic risk, to the extent possible, has been diversified away. So whatever risk remains in the market portfolio is systematic risk. This means that beta is a measure of systematic risk. The more important implication is that investors expect to be compensated only for holding non-diversifiable systematic risk and not for holding diversifiable idiosyncratic risk. Investors are expected to be smart enough to diversify away idiosyncratic risk by forming portfolios. How do we calculate an asset's beta? Beta sub I equals the covariance between the risky asset's returns and the market portfolio's returns divided by the variance of the market portfolio's returns. The covariance is denoted by COV of R sub I, R sub M, and the variance of the market portfolio's returns is denoted by sigma m squared. What can we say about the beta of the market portfolio? If we use the formula, we will have the covariance between the market's returns and the market's returns, which is simply the variance of the market's returns, divided by the variance of the market's returns. Thus, the beta of the market portfolio is 1. An asset that has a beta greater than 1 is riskier than the market portfolio, while that with a beta less than 1 is less riskier than the market portfolio. The risk-free asset by definition has no risk, and so its beta is 0. Can beta be less than 0? What does it mean to have a negative beta? The answer is yes, beta can be negative. This means that the asset's return will move in a direction opposite to that of the market's returns. If the market return is positive, the asset with a negative beta will have a negative return, and vice versa. Next time, we will use the formula for beta to calculate the beta of a risky asset. Learning outcomes. After watching this video, you will be able to calculate the covariance between a risky asset's return and the market's returns, calculate the beta of a risky asset given expected return, standard deviations, and covariances. Calculating the CAPM beta. Last time, we saw the mathematical form of the CAPM and the equation to calculate the CAPM beta. Now, we will apply this formula to calculate the betas of risky assets. Let's go back to our 3 risky asset case, but change the correlations a little. Remember, we saw that a portfolio that has negative weights for some risky assets cannot be a market portfolio. In our 3 risky asset example, Z has a negative weight in the mean variance efficient portfolio. To solve this problem, we'll change the covariances a little. We'll continue to assume that there are only 3 risky and 1 risk-free asset in the entire world. The expected return and standard deviation for X are 10% and 7% respectively. Similarly, for Y, we have 20% and 10% respectively, and for Z, we have 15% and 12% respectively. The covariance between X and Y is 0.0032. That between X and Z is 0.0013, and that between Y and Z is 0.0054. The risk-free rate is still 5%. Using Solver in Excel, you can confirm that the weights of X, Y, and Z in the mean variance efficient portfolio are 0.0546, 0.8424, and 0.1030 respectively. Since all the weights are positive, this mean variance efficient portfolio is a valid market portfolio. Remember how to calculate the expected return and standard deviation of returns for a portfolio. The expected return of the market portfolio is 0.0546 times 10% plus 0.8424 times 20% plus 0.1030 times 15%. Which gives us 18.94%. The standard deviation of the market portfolio's returns is the square root of 0.0546 squared times 0.07 squared plus 0.8424 squared times 0.10 squared plus 0.1030 squared times 0.12 squared plus 2 times 0.0546 times 0.8424 times 0.0032 plus 2 times 0.0546 times 0.1030 times 0.0013 plus 2 times 0.8424 times 0.1030 times 0.0054. The standard deviation of the market portfolio comes out to be 9.22%. To calculate the betas of the 3 assets, we need to calculate the covariance of each asset's returns with that of the market portfolio. Remember, the market portfolio itself consists of 0.0546 in X, 0.8424 in Y, and 0.1030 in Z. It can be shown that the covariance between X's returns and the market portfolio's returns can be calculated as follows. It is the covariance between X and 0.0546 of X plus the covariance between X and 0.8424 of Y plus the covariance of X and 0.1030 of Z. The covariance between X and X is nothing but the variance of X. So now we have 0.0546 times the variance of X plus 0.8424 times the covariance between X and Y plus 0.1030 times the covariance between x and z. This works out to be 0.0031. You can similarly calculate the covariances of y's returns and z's returns with the market portfolio's returns. They work out to be 0.0092 and 0.0061 respectively. I leave it up to you to do the calculations and verify these two numbers. We can now calculate the betas of the three risky assets. For X, it is the covariance of its returns with the market portfolio's returns, which is 0.0031, divided by the variance of the market's returns, which is 0.0922 squared. The beta comes out to be 0.36. Similar calculations for Y and Z yield betas of 1.08 and 0.72 respectively. Please verify these numbers. Do note that Y has the highest expected return of 20% among the three risky assets, and its beta of 1.08 is also the highest. X, on the other hand, has the lowest expected return of 10% and also the lowest beta of 0.36. This is consistent with investors demanding a higher compensation in the form of higher expected returns for holding riskier, higher beta assets. Next time, we will define a plot of the CAPM, which is called the security market line, and compare it to the capital market line. Learning outcomes. After watching this video, you will be able to describe single and multi-factor models, write out a two-factor model with unanticipated shocks to the risk factors and asset returns. Multi-factor models. So far, we have assumed that only one variable or factor, namely the market portfolio, affects expected returns. This may not be realistic for a couple of reasons. One, why is it that the market portfolio is the only factor that affects expected returns? It could be some other single factor, like interest rate in the economy or business cycle, that affects expected returns of all risky assets. Two, why must there be only one factor that affects expected returns? It is possible that there are a number of macroeconomic factors that simultaneously determine expected returns. The return of any asset can be decomposed into two parts, an expected part and an unanticipated part. The unanticipated part itself may consist of two parts, one attributable to a risk factor and another to a firm-specific shock. The return of any asset can be written as R sub I equals the expected return of the asset E of R sub I plus beta sub I times F plus E sub I. Here F is the unanticipated shock to the risk factor, beta sub I is the sensitivity of asset I's returns to the risk factor, and E sub I is the unanticipated firm-specific shock. Across all risky assets, the expectation of F and the expectation of E sub I are both equal to 0. This is because they are unanticipated shocks. For example, we could write Microsoft stock returns R sub M for the next quarter as expected return for Microsoft E of R sub M plus beta sub M times the difference between next quarter's GDP growth rate and the expected GDP growth rate plus the unanticipated part of Microsoft's return next quarter E sub M. Here we assume that the GDP growth rate is the single risk factor that affects all risky asset returns. The difference between next quarter's GDP growth rate and the expected GDP growth rate is the unanticipated shock to the risk factor. The single index model that we saw earlier is another example of a single factor model. We can extend this to a model with k factors. The return of any asset can be written as R sub I equals the expected return of the asset E of R sub I plus beta sub I 1 times F sub 1 plus beta sub I2 times F sub 2 plus so on until beta sub ik times F sub k plus E sub I. Each F sub j represents the unanticipated shock to risk factor j, and each beta sub j is the sensitivity of the asset's returns to the risk factor j. As previously, the expectation of each F sub j and the expectation of E sub I are all equal to 0. We can now extend the model for Microsoft's return next quarter, R sub m, as expected return for Microsoft, E of R sub m, plus beta sub m1 times the difference between next quarter's GDP growth rate and the expected GDP growth rate, plus beta sub m2 times the difference between next quarter's inflation and the expected inflation, plus the unanticipated part of Microsoft's return next quarter, E sub m. In this model, there are two risk factors, namely GDP growth rate and inflation. To get a better understanding of the multi-factor model, let's include some numbers. Say Microsoft's expected return is 10%. The GDP growth rate is expected to be 4%, while inflation is expected to be 6%. Microsoft has a sensitivity of 1% with respect to the GDP growth rate risk factor, and a sensitivity of 0.4 with respect to the inflation risk factor. GDP growth rate actually turns out to be 5%, and inflation actually turns out to be 7%. So Microsoft's return next quarter is 14% plus 1 times 5% minus 4% plus 0.4 times 7% minus 6% plus the unanticipated firm-specific shock. While these factor models help us decompose returns into expected and unanticipated parts, we still need to relate factor risk premiums to expected returns. Asset pricing models help us do this. CAPM was one such model. Next time, we will look at an alternate asset pricing model. Learning outcomes. After watching this video, you will be able to understand the arbitrage pricing theory, use the arbitrage pricing theory to calculate expected returns. The arbitrage pricing theory. Asset pricing models relate expected returns and risk through factor betas. The most general asset pricing model, called the arbitrage pricing theory, APT in short, posits that the expected return of asset I, E of R sub I, is the risk-free rate, R sub F, plus beta sub I1 times RP sub 1, plus beta sub I2 times RP sub 2, plus so on until beta sub Ik times RP sub k. Beta sub ij is the sensitivity of asset I's returns to factor j, and Rp sub j is factor j's risk premium. The risk premium of each factor is the excess expected return over and above the risk-free rate that investors expect as compensation for holding 1 unit of the risk factor. The CAPM is another example of an asset pricing model where the market portfolio is the only risk factor. The multi-factor models decompose an asset's actual returns into an expected part and an unexpected part, with the unexpected part being attributable to unanticipated shocks to K risk factors and unanticipated firm-specific shocks. Asset pricing model relate assets' expected returns to the risk factors through the factors' risk premiums and the sensitivity of assets' returns to the risk factors. Asset pricing models such as the APT are alternatives to the CAPM. They allow for multiple risk factors as opposed to the single one in the CAPM. Like the CAPM, the APT is a theoretical model rather than a data-based one. In APT, asset values are determined by the principle of the law of one price. The law of one price posits that assets with the same future payoff must have the same current price. Otherwise, one can make infinite profits without putting any money at risk. Such opportunities to make infinite profits without risking any money are called arbitrage opportunities. Any investor, regardless of her risk preference or wealth, will want to take advantage of such opportunities. These opportunities rarely exist, and even when they do, they last for very short periods of time. How do we determine the risk premium for each factor in the APT? To answer this, let's continue with our Microsoft example. Say we identified two special well-diversified portfolios, G and I. G has a beta of 1 with respect to the GDP growth factor and a beta of 0 with respect to the inflation factor. I has a beta of 0 with respect to the GDP growth factor and a beta of 1 with respect to the inflation factor. Such portfolios are called factor portfolios. They track this progression of specific sources of macroeconomic risk but are uncorrelated with other sources of risk. These factor portfolios will serve as the benchmark portfolios for a multi-factor security market line. Let's say that G has an expected return of 10% and I has an expected return of 13%, with the risk-free rate being 3%. Recall that Microsoft had a beta of 1 with respect to the GDP growth factor and a beta of 0.4 with the inflation factor. Let's form a portfolio Q that has a weight of 1.0 on G and a weight of 0.4 on I and a weight of negative 0.4 on the risk-free asset. Remember, weights must add to 1 and hence the weight on the risk-free asset is negative 0.4. By construction, Q has the same factor sensitivities as Microsoft. Q's expected return is 1 times 10% plus 0.4 times 13% minus 0.4 times 3%, which equals 14%. Given that factor sensitivities are the same for portfolio Q and Microsoft, Microsoft must also have an expected return of 14% to prevent arbitrage. We can verify this by using Microsoft's factor sensitivities in the APT. That is, the risk-free rate 3% plus 1 times 10% minus 3% plus 0.4 times 13% minus 3%, which equals 14%. The APT prices assets in such a way that it prevents arbitrage opportunities. Because we now have two factors, we get a security market plane with the factor sensitivities on two axes and the expected returns on the third axis. Assets that do not lie on the S&P present arbitrage opportunities. One important thing to note about the APT is that arbitrage is about relative pricing and not absolute pricing. In our example, we say that if the factor returns are 10% and 13% and the risk-free rate is 3%, Microsoft must have an expected return of 14%. It does not say anything about whether the factor returns themselves are correct. Next time, we will look at a detailed example of how APT works, which illustrates this idea of relative pricing. Learning outcomes. After watching this video, you will be able to identify arbitrage opportunities, solve for factor sensitivities, given information on asset returns, and unanticipated shocks to the risk factors. Identifying arbitrage opportunities. Let's see how the APT works using an example. Suppose we have a world with only two time periods. Now, that is t equal to 0, and the next period, which is t equal to 1. It is uncertain which state the world will be in the next period. We could have two equally likely states, each with a probability of 50% of good and bad. We have data on 3 stocks. Microsoft stock price today is 25 and will be 40 in the good state and 20 in the bad state. Intel stock price today is 20 and will be 60 in the good state and 0 in the bad state. Coke stock price today is 22.5 and will be 55 in the good state and 15 in the bad state. Is there any arbitrage opportunity here? The answer is yes. Let's form a portfolio where we buy 1 share of Coke and short sell half a share each of Microsoft and Intel. The cost of setting up this portfolio is 1 times 22.5 minus 0.5 times 25 minus 0.5 times 20, which is 0. In the good state, the payoff from this portfolio is 1 times 55 minus 0.5 times 40 minus 0.5 times 60, which comes out to be 5. In the bad state, the payoff from this portfolio is 1 times 15 minus 0.5 times 20 minus 0.5 times 0, which comes out to also be 5. Regardless of whether the good or bad state occurs next period, the payoff from this portfolio is always 5. And there is no cost of setting this portfolio up today. There is no uncertainty or risk in its future payoff. You're always guaranteed to get 5. This is the idea of arbitrage. Guaranteed profits at no cost. One can scale up this strategy to make unlimited profits. Now, which of the 3 stocks is mispriced? Remember that APT is based on the idea of relative pricing. That is, given that 2 stocks are correctly priced, 1 is incorrectly priced. Let's assume that Microsoft and Intel are correctly priced and Coke at 22.5 is mispriced. Given that the prices of Microsoft and Intel are correct, what must be the correct price of Coke? We will use APT to determine Coke's correct price. As a first step, we need to identify risk factors. To keep things simple, we'll assume that there is only one risk factor, namely the business cycle factor. The business cycle factor takes a value of 1 in the good state and 0 in the bad state. The expected business cycle factor is the probability of the good state, which is 0.5 times 1, plus the probability of the bad state, which is also 0.5 times 0, which comes out to be 0.5. This means the unanticipated shock to the risk factor in the good state is 1 minus 0.5, which is 0.5, and that in the bad state is 0 minus 0.5, which is negative 0.5. These values for the shocks to the business cycle ensure that the expectation of the unanticipated shocks is 0. We will determine the correct price of Coke in the following 3 steps. 1. Determine the factor sensitivities or betas for Microsoft and Intel. 2. Determine the factor risk premiums using APT for Microsoft and Intel. 3. Use the APT equation to price Coke. We need the returns of Microsoft and Intel in the good and bad states. In the good state, Microsoft's return is 40 over 25 minus 1, which is 60%. In the bad state, its return is 20 over 25 minus 1, which is negative 20%. You can similarly calculate the returns of Intel in the good and bad states. I'll let you verify that these numbers are 200% and negative 100% respectively. Remember the single factor model. It says that the return can be decomposed into expected returns plus beta times the unanticipated shock to the risk factor. In this example, there is no unanticipated firm-specific shock. We can decompose Microsoft's returns in both the good and bad states. In the good state, it is 0.6 equals Microsoft's expected return plus beta sub m times 0.5. In the bad state, it is negative 0.2 equals Microsoft's expected return plus beta sub m times negative 0.5. We have 2 equations in 2 unknowns. Solving for Microsoft's expected return and beta sub m, we have 20% and 0.8 respectively. We can similarly set up the equations in the good and bad states for Intel and solve for its expected return and beta. You can see the equations on the slide. They come out to be 50% and 3 respectively. We will conclude this example next time by computing the risk premium for the single risk factor and then calculating the arbitrage-free price of Coke. Learning outcomes. After watching this video, you will be able to solve for the risk premiums once we have the factor sensitivities, determine the arbitrage-free price of an asset given the prices of other risky assets, discuss a key drawback of the APT. The arbitrage-free price. Last time, we saw an example where Coke was incorrectly priced relative to Microsoft and Intel. Let's continue with that example. In this first step, we have solved for the factor sensitivities of Microsoft and Intel. In the second step now, we are going to solve for the risk premium using the APT. Write the APT for Microsoft and Intel. Remember, it says that the expected return equals the risk-free rate plus beta times the risk premium. We do not know the risk-free rate and the risk premium for the business cycle risk factor. We will have two equations, one each for Microsoft and Intel, and so we can solve for the two unknowns. For Microsoft, we have 0.2 equals the risk-free rate plus 0.8 times the risk factor premium. For Intel, we have 0.5 equals the risk-free rate plus 3 times the risk factor premium. Solving, we find that the risk-free rate is 9.09% and that the business cycle risk factor premium is 13.64%. Now for the third step. The APT must hold for all risky assets provided the no arbitrage condition holds. For Coke, the APT is the expected return of Coke equals 9.09% plus 13.64% times Coke's beta. This is one equation with two unknowns. How do we go about solving this problem? Assume that the correct price of Coke today is P. Let's write the single factor model for Coke in the good and bad states. In the good state, it is 55 over P minus 1 equals Coke's expected return plus 0.5 times Coke's beta. In the bad state, it is 15 over P minus 1 equals Coke's expected return minus 0.5 times Coke's beta. We can solve for Coke's expected return and beta in terms of P. Coke's expected return is now 35 over P minus 1 and its beta is 40 over P. Plugging this back into Coke's APT, we have 35 over P minus 1 equals 9.09% plus 13.64% times 40 over P. This is now one equation in one unknown. Solve for P to get Coke's arbitrage-free price today to be 27.08. Let's revisit our arbitrage portfolio that consists of buying one share of Coke and short selling half a share each of Microsoft and Intel. The future payoffs in the good and bad states are still 5%, but the cost to set up this portfolio today is now 4.58. So what is the rate of return on this portfolio? Without any calculations, we can confidently say that it is 9.09%. How is that possible, you wonder? The portfolio is risk-free because it always pays 5 after one period. It has no risk or uncertainty, which means that it is risk-free. So its return must equal the risk-free rate, which is 9.09%. If it is not, there will be an arbitrage opportunity. You can verify that 5 over 4.58 minus 1 is indeed 9.09%. Remember, we started off by assuming Microsoft and Intel were correctly priced and Coke wasn't. This gave us a risk-free rate of 9.09% and a factor risk premium of 13.64%. The problem with arbitrage pricing is that the risk-free rate and factor risk premium will depend on what we assume are the correctly priced assets and which one is incorrectly priced. If we assume that Intel and Coke are correctly priced and Microsoft is incorrectly priced, the risk-free rate will be 63.64% and the factor risk premium will be negative 4.55%. Similarly, if we assume that Microsoft and Coke are correctly priced but Intel isn't, the risk-free rate comes out to negative 9.09% and the factor risk premium to 36.36%. You can verify these numbers by following the 3 steps I have outlined in this example. If you look at these numbers, some of them seem absurd. What does it mean to have a negative risk-free rate or a negative factor risk premium? Is it even realistic? The answer is, of course, no. But this is the problem with the relative pricing idea that APT uses. Different sets of assets will give different values for the risk-free asset and the factor risk premiums, some of which may be absurd. We have talked about multiple factors affecting expected returns. But what exactly are these factors? Next time, we will see a popular set of factors that researchers and practitioners use. Learning outcomes. After watching this video, you will be able to describe commonly used risk factors, briefly explain why they work. Commonly used risk factors. We have discussed multi-factor models and the APT. But what should these risk factors be? A number of researchers have proposed various risk factors, but the most popular of these are those put forth by Eugene Fama and Ken French in 1993. They proposed 3 risk factors which they call RMRF, SMB, and HML. RMRF is the return on a market index minus the risk-free rate. SMB is small minus big, which is the return on a portfolio of small companies, that is, companies with low market capitalization, minus the return on a portfolio of big companies, that is, companies with high market capitalization. HML is high minus low, which is the return on a portfolio of high book-to-market ratio firms minus a portfolio of low book-to-market ratio companies. RMRF essentially captures the systematic risk of the market index. The systematic risk originates from macroeconomic factors. Fama and French argue that small firms are likely to be more sensitive to sudden changes in business conditions than big firms, and hence SMB is a factor. Firms with high values of book-to-market ratios are more likely to be in financial distress than those with low values, and hence HML is a factor. To understand the HML factor better, let's first define what book-to-market ratio means. It is the ratio of a stock's book value to its market value. The book value comes from the firm's financial statements. The market value of equity is simply its current market capitalization. The ratio tells us what its book value is relative to its market value. While there are many ways of interpreting this ratio, we will look at one way of interpreting it in the context of the HML factor. If the ratio is low, then it reflects the growth opportunities of the company. These growth opportunities are captured by a relatively higher market capitalization, leading to a low value for the ratio. On the other hand, if the ratio is high, it reflects the company's bad financial health. Since the company isn't doing well, its market value is low relative to its book value, leading to a high ratio. One thing to note is that SMB and HML do not seem obvious choices for risk factors, but Fama and French provide empirical justifications to use them as risk factors. Thus, SMB and HML may capture sensitivity to unknown risk factors in the macroeconomy, which is why they work well in explaining observed returns. A large body of research shows that the Pharma-French three-factor model works in markets all over the world as well as over time. But the thing to note is that the model has worked well for the last 90 years or so, but there is no guarantee that it will work well for the next 50 or even 100 years. This is the problem with having empirical models rather than theoretical models like the CAPM or APT. In 1997, Mark Carhart added a fourth factor, one based on persistence in stock performance called the momentum factor, MOM. This is the return on a portfolio of companies that have performed well in the recent past, called winners, minus the return on a portfolio of companies that have performed badly in the recent past, called losers. Recent winners continue to perform well, whereas recent losers continue to perform badly. Historically, these four factors, RMRF, SMB, HML, and MOM, explain over 80% of the variation in stock returns, and hence they are commonly used risk factors in multi-factor models. In this video, we will start looking at the mechanics of trading. Specifically, we will define what orders are and look at the two most common types of orders, market orders and limit orders. We will also list the main pros and cons of these two types of orders and define what limit prices are. Until now, we have focused on the basics of financial statements and ratio analysis, and also the relationship between systematic risk and expected returns. We now move on to our next topic, which is understanding the mechanics of trading on exchanges as well as measuring associated trading costs. The mechanics of trading will list common types of orders you can use while trading and illustrate how orders get executed on exchanges. Transaction costs eat into returns that you earn from your investments. So it is important to understand how to measure transaction costs and then use and manage your orders in such a way to minimize your transaction costs. The first step in understanding the trading process is to define what orders are. When you want to trade a financial security on an exchange, you have to send instructions to the exchange, typically through your broker. These instructions are called orders. An order must always specify the security or securities you want to trade, specify whether you want to buy or sell them, and the quantity you want to trade. The security is usually specified using a ticker symbol. For example, the ticker symbol for Amazon is AMZN, and that of Ford Motor Company is F. Your order may also include some other instructions like what price you're willing to trade at, when the order expires, if the order must be executed completely, which exchange the order must be sent to, etc. The simplest type of an order is called a market order. It includes only the three required instructions, that is, the security you want to trade, whether you want to buy or sell, and the number of shares you want to trade. For example, an order to buy 100 shares in Twitter is a market order. This order accepts whatever price is currently available in the market. There is almost no uncertainty in execution, but the price at which you buy these 100 shares is uncertain. At times, this uncertainty in price may not be a good strategy. For example, you may not be willing to pay more than $19 a share for Twitter shares, as you feel that at a greater price, there are no profits to be made from buying shares in Twitter. To avoid trading at a price that is unacceptable to you, in addition to the three instructions, you may also specify the price at which you're willing to trade. Such orders are called limit orders. They still include the three basic instructions, but also include a price as the fourth instruction. Since you're not willing to buy Twitter shares at above $19, your limit order could be to buy 100 shares in Twitter with a price of $19. This price is referred to as the limit price. For a buy order, the limit price ensures that you do not buy at a price greater than $19. The maximum price at which you could trade is $19. Prices lower than $19 are, however, acceptable. Similarly, for sell orders, the limit price is the least price at which you're willing to sell. Similarly, for sell orders, the limit price is the least price at which you're willing to sell. Say you send a limit order to sell 50 shares in Twitter with a limit price of $20. This ensures that you never sell the 50 shares at less than $20 a share, but any price equal to or greater than $20 is acceptable. With limit orders, you will not trade at unfavorable prices, but then its execution is uncertain. To summarize, with market orders, execution is certain, but price is uncertain. While with limit orders, execution is uncertain, but price is more or less certain. Your order choice will depend on whether you want quick execution or you want to control what prices you trade at. Most exchanges these days are what are called electronic limit order book markets. On these markets, traders submit limit and market orders and trade with each other. Next time, we will see how limit and market orders form the order book and interact with each other. In this video, we will see limit orders enter the order book and await execution. We will define what the best ask and bid prices are and what the bid-ask spread is. We will also define what depth is. Further, we will see how market orders and some types of limit orders interact with the order book, leading to trades. We will distinguish between marketable and standing limit orders. Let's illustrate the idea of an order book using an example. Consider the limit order book for some stock XYZ Incorporated. The order book currently is empty. A trader then sends in an order to sell 150 shares of XYZ Incorporated with a limit price of $40. For ease of reference, let's call the sell order S1. This order sits on the sell side of the book. The lowest price at which someone is willing to sell shares in a stock is referred to as the best ask price. This means that the current ask price is $40. A few seconds later, a buy order for 225 shares at a price of $39.95 enters the market. Let's call this buy order B1. The S1 is not willing to sell at a price lower than $40, while B1 is not willing to pay more than $39.95 to buy shares of XYZ. So the two orders cannot trade against each other. This new buy order sits on the buy side of the book. The highest price at which someone is willing to buy shares in a stock is referred to as the best bid price. The current best bid price after this limit buy order arrives is $39.95. Prior to that, there was no best bid price as there were no buy orders in the order book. The difference between the best ask price and the best bid price is called the bid-ask spread. In our example, this is 40 minus 39.95, which means that the bid-ask spread is 5 cents. Since both these orders did not execute immediately and instead entered the limit order book and await execution, they are sometimes referred to as standing or passive limit orders. These orders provide liquidity against which other traders who demand liquidity will trade. You can also see that if no other order arrives, these two orders will not execute. This is the execution uncertainty that we talked about last time. There is no guarantee that they will be executed or filled. Moving on, a few seconds later, another buy order B2 arrives at the market. This order is for 500 shares at a price of $39.97. You can verify that B2 will also not execute against S1 because the prices at which they are willing to trade do not match. However, B2 is at a higher price than B1 and so it improves on the best bid price. The new best bid price is $39.97 and the new bid-ask spread is 40 minus 39.97, which is 3 cents. To quickly summarize the order book at this point, there is one sell order at $40 for 150 shares. There is one buy order at $39.97 for 500 shares and another one at $39.95 for 225 shares. The number of shares available for trading at each price is referred to as the depth. The depth at the best ask price of $40 is 150 shares, and the depth at the best bid price of $39.97 is 500 shares. Next, we see a market order S2 to sell 300 shares arrive. Remember, market orders do not have any price restrictions and they will trade at the current market prices. Since this is an order to sell, it will interact with the buy orders in the order book. Specifically, it will start at B2, which is at the best bid price of $39.97 for 500 shares. S2 is only for 300 shares, so it will get executed or filled completely at $39.97. We will see a trade at $37.97 for 300 shares. In the case of S2, we can see that execution was instantaneous, and this goes back to our discussion of market orders having no execution uncertainty. After this trade, the best bid price stays at $39.97, but the depth at this price has gone down to 200 shares. The next order S3 to arrive is a sell order for 250 shares with a limit price of $39.95. The question now is, what will happen to this order? Will it sit in the order book awaiting execution like the earlier limit orders S1, B1 and B2? The answer is no. It will behave like a market order and execute immediately. How does this happen? Remember, B2 is willing to pay a maximum price of $39.97 and B1 a maximum price of $39.95. S3, however, is willing to sell at a price as low as $39.95, but higher prices are acceptable. This means that the prices at which B1 and B2 are willing to buy shares are prices at which S3 is willing to sell. Since the best bid is $39.97, S3 will execute at that price first. But the depth at $39.97 is only 200 shares, whereas S3 is a sell order for 250 shares. This means 200 of S3's 250 shares will be filled at $39.97. We will see a trade for 200 shares at $39.97. This results in B2 completely being filled. S3 still needs 50 shares and B1 is at a price of $39.95. This price is also acceptable to S3 as its limit price is $39.95. The remaining 50 shares of S3 will execute at $39.95, which is what we will observe as a trade. Orders such as S3, which are limit orders but execute instantaneously, are usually referred to as marketable limit orders or active orders. Like market orders, their execution is not uncertain, but the price is uncertain. In the case of S3, even though its limit price was $39.95, it was executed at two different prices, namely $39.97 and $39.95. But none of the prices were lower than its acceptable price of $39.95. After S3's execution, the best bid price has dropped back to $39.95 and the bid-ask spread is back to 5 cents. S1 and the balance of B1, which is now 175 shares, continue to sit in the order book awaiting execution. Next time we will continue to see some other order book dynamics which will further your understanding of how the limit order book market works. In this video, you will see what happens if a marketable limit order is unable to execute entirely because of its limit price restriction. We will also see how a large market order executes against the order book and moves prices. This will help you understand the idea of price impact. Let's continue with the order book example from last time. At the end of the last video, the order book had S1 a sell order at a price of 40 for 150 shares and B1 a buy at a price of 39.95 for 175 shares. Let's move the order book forward by some time by adding a few more orders on both sides of the market. S1 and B1 continue to be on the order book. We now also have S4, a sell order for 500 shares of 40.02, S5, another sell order for 1000 shares of 40.05, and S6, another sell order for 1500 shares at 40.10. On the buy side, we have B3, an order for 600 shares at 39.99, and B4, an order for 900 shares at 39.96. The best ask price continues to be 40, while the best bid price is 39.99. Consequently, the bid-ask spread is 1 cent. Note, in reality, we will not see the individual orders and their respective sizes at each price. We will only see the aggregate depth across all orders at a given price. In other words, the depths at each of the prices we observe in the order book may be contributed by multiple orders or a single order. That is something we will not know precisely. For example, the depth of 1000 shares at 40.05 may be because of 3 different sell orders, each with a limit price of 40.05 and one order being for 300 shares, another for 500 shares and a third for 200 shares. In this example, for simplicity, I am assuming that there is one order at each price that contributes to the entire depth at that price. Now a buy order B5 arrives for 400 shares at 40. Will this order execute against any of the sell orders? Let's see what happens. This trader is willing to pay as much as $40 for each share. Is someone willing to sell shares at that price or lower? The answer is yes. S1 is willing to sell 150 shares at $40. So B5 will execute against S1 and we will see a trade for 150 shares at $40. Even though B5 wants to buy 400 shares, S1 is willing to sell only 150 shares at $40 and so the trade will be for only 150 shares. Now that S1 is completely filled, what happens to the remaining 250 shares that B5 wants to buy? The limit price is still 40 and it won't pay more than that for each share. Is anyone else in the market willing to sell at 40 or less? No. S4 is not willing to sell at a price lower than 40.02 and S5 is not willing to sell at a price lower than 40.05. So what happens to the balance 250 shares of B5? It will become a standing limit order at 40 for 250 shares. That is, the balance will sit in the order book awaiting execution. On the sell side, the lowest price at which someone is willing to sell is S4's 40.02, which is now the best ask price. On the buy side, the highest price at which someone is willing to buy shares is now B5's 40, which becomes the new best bid price. The bid-ask spread is now 2 cents. The depth at the best ask price is 500 shares and that at the best bid price is 250 shares. Next, a market order B6 to buy 200 shares arrives in the market. This order has no price restrictions and will execute immediately against existing sell orders in the order book. S4 is for 500 shares, S5 is for 1000 shares and S6 is for 1500 shares, which add up to 3000 shares. So there is enough number of shares on offer to completely fill B6. We will see a trade for 500 shares at 40.02, which is S4 executing against B6. Another one for 1000 shares at 40.05, which is S5 executing against B6. And a third one for 500 shares at 40.10, which is S6 executing against B6. Here we can see the price uncertainty of market orders while execution itself was guaranteed. Even though the best ask price was 40.02, the market order executed at prices higher than that also. After these trades, the best bid price of 40 for 250 shares remains unchanged. However, the best ask price is now 40.10 for 1000 shares and the bid ask spread is 10 cents. This market buy order has moved the best ask price by 8 cents, which is typically referred to as the price impact of an order. Since there are no price range for a market order, market orders could end up moving prices substantially, especially when they are large. To summarize the book at this point, there is only one sell order S6 at 40.10 for 1000 shares. On the buy side, we still have B5 at 40 for 250 shares, B3 at 39.99 for 600 shares, B4 at 39.96 for 900 shares, and B1 at 39.95 for 175 shares. At this point, a new sell order S7 enters the market at 40.05 for 500 shares. This brings the best ask price down to 40.05 and the bid ask spread drops to 5 cents. In the last couple of videos, we have seen how the order book changes dynamically as orders await execution while other orders execute immediately. Orders that sit in the book awaiting execution are usually considered to be providing liquidity in the market, while those that execute immediately demand or consume liquidity. Next time, we will discuss the idea of limit price placement and order aggressiveness. In this video, we will discuss the idea of limit price placement. That is, where does the limit price of your order lie relative to the best quotes? This leads to the idea of order aggressiveness. We will also introduce the idea of liquidity demanding and liquidity supplying orders. For this video, let's assume, unless noted otherwise, that the best ask is at $40 for 150 shares and the best bid is at $39.95 for 225 shares. An order's aggressiveness depends on how far its limit price is from the best quotes. Market orders are the most aggressive orders as they have no limit prices. Alternatively, you could consider market orders to sell as limit orders to sell with a limit price of 0 and market orders to buy as limit orders to buy with a limit price of infinity. Limit orders that fill completely almost instantaneously are also extremely aggressive. These are what we called earlier as marketable limit orders. Examples of such orders are when buy orders have a limit price greater than or equal to the best ask price and sell orders have a limit price less than or equal to the best bid price. With our best quotes of $40 and $39.95, an extremely aggressive sell order would have a limit price way below $39.95 and an extremely aggressive buy order would have a limit price way above $40. The lower the limit price of a sell order relative to the best bid price, the more aggressive it is. Similarly, the greater the limit price of a buy order relative to the best ask price, the more aggressive it is. For a given number of shares, a sell order with a limit price of 39.25 is far more aggressive than one with a limit price of 39.50. On the other side, a buy order with a limit price of 40.40 is far more aggressive than one with a limit price of 40.20. Limit orders that fill only partially when submitted are less aggressive and can be considered as the third most aggressive set of orders. An example would be to send a sell order for 500 shares with a limit price of $39.95. I will let you verify that it will not execute completely. Similarly, a buy order for 220 shares at a limit price of $40 will also not execute completely. I will again let you verify this and understand what happens to the best quotes in both cases. Next, there are orders that simply improve the best quote without any execution. They form the fourth most aggressive set of orders. Relative to our best quotes of 40 and 39.95, this would mean, for example, submitting a limit order to sell at 39.99 or submitting a limit order to buy at 39.97. These do not result in any executions but simply narrow the bid-ask spread. The next most aggressive set of orders are those that simply add more shares at the best bid or ask prices without altering the best quotes in any way or any executions. An example would be to submit a buy order for 50 shares with a limit price of 39.95. This will simply increase the depth at the best price by 50 shares to 275 shares. Similarly, submitting a sell order for 100 shares with a limit price of 40 would increase the depth at the best ask price to 250 shares without altering the best ask price. And finally, there are those orders that add additional depth at prices worse than the best quotes. An example of this would be to submit a buy order for 500 shares at a price of 39.90. This will go sit in the book behind the best bid and await execution. Orders that result in at least partial executions at the time of submission are typically considered to be orders that consume or demand liquidity. They trade against orders that await execution on the order book. Those that sit on the order book awaiting execution are considered to supply or provide liquidity to the market. In the last few videos, we have seen how the order book changes dynamically as some orders await execution while others execute immediately. In this video, we understood the idea of order aggressiveness. Next time, we will look at some other common types of orders and order instructions. In this video, we will discuss what stop loss orders are and the purpose they serve. You will be able to differentiate between stop or trigger prices and limit prices. You will also have an understanding as to how to select the trigger price of a stop loss order given the stock's daily volatility. Another fairly common type of order that traders use is a stop loss order. As the name suggests, these are used to prevent losses on existing positions. These orders are also referred to as stop orders or stop market orders. Let's look at an example to see how stop loss orders work. Say you bought 100 shares in XYZ Incorporated at $40 a share. While you would like it if prices increase beyond $40 a share, you want to make sure that prices don't decrease precipitously, leading to large losses. Say you're okay with about a 10% loss. So you place a stop loss order to sell 100 shares of XYZ with a stop or trigger price of $36. Stop loss orders are held separately and do not show up in the order book we saw in the previous videos. However, they still have to interact with orders in the regular order book for execution. Going back to our example, as long as trades are being executed at prices above $36, nothing will happen to your stop loss order. However, the moment a trade is executed at 36 or below, your stop loss order to sell will be triggered into a regular market order to sell 100 shares. It will execute against orders sitting on the order book at whatever prices are available then. This may be at prices below or above $36, depending on how prices have moved after your order is triggered. While the time between it being triggered and it being executed may be small, a matter of less than a second usually, in extremely volatile conditions, price changes may be fairly substantial in even less than a second. It is important to understand the difference between the trigger price and the limit price. Let's say that I have a limit order to sell 100 shares at $36 as well as a stop loss order to sell 100 shares with a trigger price of $36. The limit order ensures that I never sell my shares at less than $36 a share. It guarantees the minimum price I will get for my 100 shares. On the other hand, in the case of the stop loss order, the order is activated or triggered when transaction prices reach $36 or below. Price uncertainty still exists even after the order is triggered, and the actual price at which you sell the shares may be above or below $36. That just depends on how quickly prices are changing in the market. Should you keep anything in mind while deciding the trigger price relative to the price at which you bought the shares? In our example, you were willing to take a 10% loss and hence you selected a trigger price of $36. What if the stock's returns had a daily volatility of 15%? The trigger price of your order is only 10% below the price at which you bought your shares, whereas the daily price fluctuations are typically larger than that. This means your stop loss order will likely be triggered during the course of a normal day of trading. This is not necessarily a good idea, as you should use stop loss orders only to protect yourself from loss-making sustained price movements and not regular volatility. Until now, we have assumed that when a stop loss order is triggered, it triggers a market order. We've already seen that this leads to price uncertainty, especially when prices are changing rapidly in the market. You could place stop loss orders that trigger limit orders. For such orders, in addition to a trigger price, you must also specify a limit price. So when the order is triggered, it tries to execute against existing limit orders in the order book, subject to not selling below the limit price. If the order cannot execute, it will become a passive order and sit in the book awaiting execution. While using a stop loss limit order reduces price uncertainty, it increases execution uncertainty. In fast moving markets, this could mean that your limit order does not execute after it is triggered. It may be better to use stop loss market orders as your guaranteed execution, though at possibly an additional loss. In this video, we have assumed that you buy shares and then restrict your losses by placing a stop loss order to sell. The opposite is also possible. That is, you sell shares now assuming that prices will drop, but then place a stop loss order to buy if prices increase. In this context, we have to understand the idea of short selling, which we will cover next time. In this video, we will discuss what short selling is and how you would use a stop loss order to restrict your losses after you have short sold shares. Last time, we assumed that you buy shares and then restrict your losses by placing a stop loss order to sell. The opposite is also possible. Say you have information that the stock price is going to drop. Ideally, you would want to sell the shares now and buy them back after the stock prices drop. However, what if you do not own the shares? Can you still sell on the information that the stock price is going to drop? The answer is yes, through what is called short selling shares. Essentially, short selling means that you sell something that you do not own. How do you do that? By borrowing shares from someone and selling them with a promise to return the borrowed shares at a future date. This is similar to taking a loan. In a loan, you borrow cash and promise to pay it back by some future date. In the case of short selling, the loan is for shares and not cash. Various countries have regulations on how this borrowing may be done. Some countries may completely ban it, while others may ban it from time to time for various reasons. You will have to check if and how you can borrow shares on your local exchange. I do want to add a word of caution here that short selling is extremely risky because stock prices in general increase over longer horizons of time. It is not meant for everyone and also not advisable to hold such positions over long periods of time. Let's say that you expect the share price of XYZ to decrease. Because you don't own shares of XYZ, you decide to short sell shares in XYZ. You are able to short sell 100 shares at $40 a share. If your information is right, then prices will decrease, you will buy the 100 shares back at a lower price and return the borrowed shares. However, if you're wrong, then prices may increase, leading to losses because you still have an obligation to return the borrowed shares. You will have to buy the shares back at higher prices, which result in losses. To prevent really large losses on account of price increases, you enter a stop loss order to buy 100 shares at $44 a share. You're willing to lose around 10% on this transaction. As long as the stock trades at prices below $44, your stop loss order to buy isn't triggered. However, the moment the stock trades at $44 or higher, it will trigger your stop loss order, which will convert to a market order and will try to execute against limit orders in the order book. Remember, a stop loss order at $44 doesn't guarantee purchases at $44 or lower. The order is activated when the stock price reaches $44. The actual price at which you buy the shares may be greater than or less than $44. There is still price uncertainty, and this is especially higher when prices are changing rapidly. To reduce this price uncertainty, you could place a stop loss order with a limit price. When triggered, this would send a limit order to the market, which will try to execute against the order book, subject to not exceeding the limit price. However, it is common practice to place stop loss market orders rather than stop loss limit orders because there is some urgency in getting the order executed. We will continue talking about different types of orders that traders may place in the market next time. We will look at various additional instructions you may attach to an order. Over the last few videos, we have covered some of the more common types of orders that a trader may place. This includes market orders, limit orders, and stop loss orders. In this video, we will cover some other instructions a trader may add to market and limit orders. These instructions may be broadly classified into validity, quantity, and display instructions. These additional instructions are not commonly used but are still used in significant numbers to serve specific purposes. The first set of order instructions we will look at are validity instructions. Under this, the first type of order with instructions is day orders. These orders are valid only for the day on which the trader places them. If unexecuted by the end of the day on which they were placed, they are automatically cancelled. These would typically be limit orders rather than market orders, as the latter would execute almost instantaneously. Looking at other validity instructions, we have orders that are valid until some future date or event. These are broadly called good till orders. We have good till cancel orders, GTC orders in short. These orders are valid until execution or cancellation by the trader, whichever happens first. They could be valid for less than or longer than a day. We then have good till week, GTW, good till month, GTM, and good till date, GTD orders. GTW orders are valid for the week in which they are submitted and automatically cancelled if still unexecuted at the end of the week. Similarly, GTM orders are valid for the month in which they are submitted and again are automatically cancelled if still unexecuted at the end of the month. For GTD orders, they are valid until a specified calendar date, after which they are cancelled if still unexecuted. In derivative markets, we have good till expiration, GTE orders. Unlike stocks, derivatives are finite-lived securities and expire on a specific calendar date. In these markets, you may submit orders that are cancelled on the derivative's expiration date if still unexecuted. While good till orders are valid until a specific time, date, or event, there are orders that are valid only after a specified time or date. These are called good after time or good after date, GAT orders. These orders may be executed only after a specified date or time. Then there are orders that may be executed only at the time the market opens or closes. We have market on open and market on close orders. Market on open orders are market orders that will execute when the market opens for the trading day. This order is usually used when the market opens with a call option. Similarly, market on close orders are market orders that can be executed only at the closing price for the day. We then have orders that will execute only if certain quantity conditions are met. Otherwise, they are automatically cancelled. The first of this type of orders is immediate or cancel orders, IOC orders. They are also called good on-site orders. The order must execute immediately at its limit price or better. Any unexecuted part is cancelled immediately. Given its limit price, if no part of the order can be executed immediately, then the entire order is cancelled right away. A slight variation of this order type is the fill or kill, FOK orders. Here the entire order must be executed immediately or cancelled in its entirety. Partial executions of FOK orders are not allowed, while partial executions of IOC orders are acceptable. While FOK orders require full execution immediately or will be cancelled entirely, we have all or none AON orders which require full execution but do not demand immediacy in execution. They will wait in the order book until they can be executed completely in a single shot. We also have minimum volume orders which require a minimum quantity to be executed. Otherwise, the order won't execute. The final set of order instructions is display instructions. Display instructions typically apply to limit orders that sit in the order book awaiting execution. In such cases, other traders may be able to infer some information and trade ahead of the orders in the order book. This may move prices away from the orders, leading to non-execution of these orders. To prevent this from happening, traders may choose hidden orders or iceberg orders. Hidden orders are completely invisible in the order book and their existence is unknown unless there is a trade. Let's look at a simple example. The displayed best bid and offer prices are currently at 40 and 40.05 respectively. You submit a market order to buy shares, expecting it to trade at 40.05, the best ask price. However, you see that it executes at a slightly lower price of say 40.03. This suggests that there is a hidden order at 40.03. This is the only way to uncover these orders in the order book. A related type of order is an iceberg order. You may submit an order to sell 1000 shares with an instruction to reveal only 100 shares at a time. Once the first 100 shares are executed completely, the next 100 shares are revealed in the order book. This continues until the order is completely executed or cancelled. A final type of order, which does not fall into the three broad buckets of orders we have identified, are spread orders. They are usually possible only on derivatives exchanges. With spread orders, you try to buy a security with a particular expiration date and try to sell a related security with a different expiration date. These orders could be any combination. These orders could be a combination of market and limit orders. An important thing to keep in mind with regards to the various order instructions is that on most exchanges, including additional instructions or constraints would simply delay order execution. Exchanges give first priority to orders with no conditions attached. So regular market orders and limit orders with no additional instructions would typically execute before any other type of orders. The only exception are IOC and FOK orders, which by design demand immediate execution or cancellation. While deciding on whether to add any additional conditions to your order, determine if they are necessary. The trade-off is that including additional instructions may get you the execution you want, but the downside is that it may delay execution. Which is more critical to you? At times, you may be better off with immediate execution, whereas at other times, you may be better off with including additional instructions to your order. Also, while we have talked about a number of order instructions, they may not all be permitted on every exchange. Make sure that you know which orders are permitted and which aren't before deciding on your order submission strategy. Next time, we will talk about the idea of liquidity and its various dimensions. It is important to understand liquidity because it helps us better understand costs that we incur when we trade. Until now, we have looked at the different types of orders traders may use, including additional instructions that may be included. Next, we turn to understanding what liquidity is. We will also look at the various dimensions of liquidity. This will help us better understand and measure transaction costs that we incur while trading. Let's first formally define what liquidity is. It is the ability to trade quickly, in the quantity you want, and at a low cost. It is one of the most important characteristics of an exchange. There is a common saying that liquidity begets liquidity. Regulators and exchanges aspire to have highly liquid marketplaces as this attracts traders in large numbers, thereby increasing liquidity even more. There are a number of dimensions of liquidity. The first is immediacy. It tells us how quickly can trades of a given size be executed at a given cost. For example, say you want to buy 100 shares of a stock and do not want to pay more than 5 cents a share in transaction cost. How long will it take for you to execute this order? If you buy the 100 shares at a cost of 5 cents a share almost immediately, the market is extremely liquid as it provides a high level of immediacy. A second dimension of liquidity is the width of the market. This measures what the cost of trading a given size is. What will it cost you to buy 100 shares? This is usually measured by the bid-ask spread. A narrow spread tells us that the transaction costs are low and the market is very liquid. On the other hand, wider spreads indicate that markets are illiquid. A third dimension of liquidity is the depth of the market. It measures the trade size that can be executed at a given cost. For example, if the bid-ask spread is 5 cents, how many shares can be traded without changing the spread? If there are a large number of shares to be bought and sold at the best bid and ask prices, then you can trade a large order without moving prices much. Here again, we would prefer markets with high depth. The fourth dimension of liquidity is resiliency. It tells us how quickly prices revert to previous levels after a large trade is executed. For example, say an order for 10,000 shares moves prices by 50 cents and the bid-ask spread widens from 5 cents to 55 cents. If traders refill the order book quickly and bring down prices by 50 cents and the bid-ask spread back to 5 cents, then the market is said to be resilient. A liquid market is where traders can execute large orders with minimal price impact almost instantaneously. Even when prices move on account of a large order, markets are liquid if prices revert quickly. Next time, we will start discussing how to measure transaction costs and the various benchmarks we use for it. Last time, we discussed the idea of liquidity and its various dimensions. Even in the most liquid of markets, investors still have to bear transaction costs. This can't be avoided. These costs reduce the returns a person earns from their investments. To increase returns net of transaction cost, it is critical to understand what the transaction costs are, how to measure them, and then attempt to trade in a manner that reduces these costs. In this video, we will focus on discussing what the transaction costs are and how to measure them. In the next video, we will illustrate these calculations with an example. Transaction costs help investors evaluate how well they and their brokers have executed their trading strategies. It is also used by exchanges, brokers, and regulators. Exchanges are interested in calculating transaction costs to determine how liquid their market is and use this as part of their marketing strategies. They also help brokers evaluate their execution performance. It helps them identify better execution strategies that minimize transaction costs. Regulators too are interested in calculating transaction costs as they help them monitor the performance of exchanges and change policies accordingly to further reduce transaction costs on exchanges. How do we measure transaction costs? It is the difference between the value of a paper portfolio and the value of a real portfolio. Say that you decide to put together a portfolio of stocks worth $100,000. The paper portfolio will assume that you paid the decision time midpoint of the best bid and ask prices. However, in reality, you have to pay the bid-ask spread, brokerage commissions, price impact, fees, taxes, etc. All of these will affect the actual return you realize from your investment portfolio. There are two components to transaction costs. One is the explicit cost and other is implicit costs. Explicit costs are actual out-of-the-pocket expenses incurred. They include brokerage commissions and any taxes and fees paid for every transaction. These are easy to identify and measure and need to be simply added up. Implicit costs are those that are not obvious but still imposed on traders. These include spreads, market impact costs, opportunity costs, delay costs, etc. Implicit costs are more difficult to identify and quantify. For example, if we want to measure the price impact of a trade, we must have some estimate of what the price would have been had the trade not taken place. Unfortunately, we can't observe that. There are a number of ways to measure these implicit costs. The only difference among these different ways is the benchmark used. One-way implicit transaction costs have the following general form. It is the summation over all trades executed by a trader of the product of the size of each trade denoted by X sub j times the direction of trade denoted by D sub j times the difference between the trade price P sub j and the benchmark at the time of trade denoted by B sub j. Trade direction takes a value of +1 if it is a buy order and a value of -1 if it is a sell order. Essentially, these implicit costs measure how large a premium over the benchmark a trader is willing to pay while buying and how large a discount relative to the benchmark a trader is willing to accept while selling. The benchmark is assumed to represent the true value of the stock. Round-trip implicit transaction cost is 2 times the one-way implicit transaction cost. There are 5 common benchmarks used to compute implicit transaction costs. They are time-weighted average price, TWAP, volume-weighted average price, VWAP, decision time bid and ask price midpoint, closing price, and one-way effective spread. For a stock with n trades in a given day, TWAP is the average transaction price across these n trades. VWAP is the trade size weighted average transaction price. The price of each transaction is multiplied by its size and then divided by the total volume traded for the day. This is summed up across all trades of the day to give us the VWAP for the day. The third benchmark is the midpoint of the bid and ask prices at the time the investor decides to trade. In other words, the decision time. In this case, in addition to the difference between the trade price and the benchmark, the transaction cost also captures an opportunity cost for the part of the order that is not executed. This method is called the implementation shortfall method. For each trade, we have the trade size X sub j times the trade direction D sub j times the difference between the trade price P sub j and the decision time bid ask price midpoint denoted by M sub D. This is added across all trades for the day. The opportunity cost is computed as the difference between the total order size capital X and total number of shares bought or sold, the summation of X sub j across all trade times the order direction D times the difference between the last price of the day P sub capital N and the decision time bid ask midpoint M sub D. The difference between X and the summation of all X sub j's represent the part of the order that isn't executed by the end of the day. This non-execution results in an opportunity cost due to potentially lost profits. This is captured by the difference between P sub N and M sub D. For a buy order, it assumes that you could have bought the shares at M sub D and sold them at P sub capital N at the end of the day. If prices increase during the day, this is lost profit. On the other hand, if prices decrease during the day, this difference is losses avoided. The implementation shortfall method adds this opportunity cost to the implicit transaction cost calculated using the decision time bid-ask price midpoint as the benchmark. A fourth benchmark is the closing price of the day, which is typically the price of the last transaction of the day. A fifth benchmark is the midpoint of the bid and ask prices at the time of trade. There are a few other benchmarks that traders use which we won't focus on. Nevertheless, I will list them here. These are the previous day's closing price, the current day's opening price, the next day's closing price, the bid-ask price midpoint at the time the order arrives in the market, and the average of the day's open, high, low, and closing prices. Next time, we will look at a detailed example that will illustrate how to compute these benchmarks and then calculate implicit transaction costs. Last time, we discussed that it is important to account for transaction costs as they reduce the returns investors earn. We divided transaction costs into explicit and implicit costs. Implicit costs depend on the benchmark used. We looked at various benchmarks and how to calculate them. In this video, we will illustrate the calculations of these benchmarks and implicit transaction costs with an example. Let's look at an example to understand the 5 benchmarks better. Say the market opens at 9:30 a.m., at which point 10,000 shares of XYZ stock trade at $45.66 a share. You decide to place an order to buy 1,200 shares of XYZ at 10:30 a.m. The best bid and ask prices at this time are $46.05 and $46.08 respectively. This yields a midpoint of $46.065 at decision time. This is the benchmark for the implementation shortfall method, which was denoted as M sub D. Another trader's order executes at 11:08 a.m. at a price of 46.2 for 650 shares. The best bid and ask prices at this time are 46.2 and 46.22 respectively. At 11:46 a.m., 460 shares of your order gets executed at a price of $46.05. Another trader's order for 2000 shares is executed at 2:16 p.m. at a price of 46.15. At 3:45 p.m., another 530 shares of yours are executed at $46.03. The best bid and ask prices at this time are 45.99 and 46.03 respectively. Finally, the market closes at 4 p.m. when the best bid and ask prices are 45.91 and 45.94 respectively. For simplicity, we'll assume that there are no other transactions in XYZ stock during the day. The first benchmark is the TWAP, which is a simple average of the transaction prices of the day. Transactions were executed at 45.66, 46.20, 46.05, 46.15 and 46.03. Adding these 5 numbers and dividing by the total number of transactions for the day, which is 5, yields a TWAP of 46.018. The implicit transaction cost is a summation across all trades of trade size times the trade direction times the difference between the trade price and benchmark. In this case, since you're buying, trade direction is +1 in all our calculations. Your transaction cost is 460 times 46.05 minus 46.018 plus 530 times 46.03 minus 46.018, which gives us a transaction cost of $21.08. The second benchmark is the VWAP. It is a trade size weighted average price for the day. On this day, the first transaction was for 10,000 shares at 45.66, the second one for 650 shares at 46.2, the third one for 460 shares at 46.05, the fourth one for 2,000 shares at 46.15, and the fifth one for 530 shares at 46.03. The VWAP is 10,000 times 46.66 plus 650 times 46.20 plus 460 times 46.05 plus 2000 times 46.15 plus 530 times 46.03 divided by the total number of shares traded for the day, which is 10,000 plus 650 plus 460 plus 2000 plus 530. The VWAP works out to 45.785. Given this, we can calculate your transaction cost as 460 times 46.05 minus 45.785 plus 530 times 46.03 minus 45.785, which gives us a transaction cost of 251.64. Since the opening price was a large trade at a very low price, VWAP is far lower than TWAP, which leads to a significantly higher implicit transaction cost when we use VWAP as a benchmark. The third benchmark is the bid-ask midpoint at decision time. You decide to buy 1200 shares at 10:30 a.m. when the midpoint was 46.065. The transaction cost hence is 460 times 46.05 minus 46.065 plus 530 times 46.03 minus 46.065, which gives us a transaction cost of negative $25.45. Interestingly, your transaction cost now is negative as both your transactions are at prices below the decision time midpoint. This method also captures the opportunity cost of not executing the order completely. Out of the 1200 shares you wanted to buy, you ended up buying only 460 plus 530, which is 990 shares. So the opportunity cost is on 1200 minus 990, which is 210 shares. The closing price for the day is the price of the last trade of the day, which is 46.03. So the opportunity cost is 210 times 46.03 minus 46.065, which is a negative $7.35. Adding the opportunity cost of negative 7.35 to the transaction cost of negative 25.45 yields implicit transaction cost of negative 32.80 through the implementation shortfall method. In this case, prices decreased after you decided to buy shares and hence the transaction costs are negative. In this case, the delay in execution worked in your favor and helped you save money. Had prices increased, you would have incurred a cost. The fourth benchmark is the closing price. The price of the last transaction is 46.03. So the transaction cost here is 460 times 46.05 minus 46.03 plus 530 times 46.03 minus 46.03, which gives us a transaction cost of $9.2. Here prices decrease towards the end of the day and hence you buy at prices higher than the benchmark. The last benchmark is the bid-ask midpoint at the time of trade. Since you had two transactions, we have to determine the benchmark separately for each transaction. The bid-ask midpoint for the first transaction was 46.035 and that for the second transaction was 46.01. Hence, the one-way effective spread is 460 times 46.05 minus 46.035 plus 530 times 46.03 minus 46.01, which gives us a one-way effective spread of $17.5. The one-way effective spread will usually be positive as traders will buy at prices above the bid-ask midpoint at the time of trade and sell at prices below the midpoint at the time of trade. In our example, the various benchmarks have yielded very different values of transaction costs. There isn't one correct or wrong value. Since the benchmarks are different, each will yield a different value. These will usually be affected by how prices move during the day. On days when prices move favorably, your transaction costs will be negative. That is, you make a profit by trading or not trading as the case may be. On other days, when prices move against you, transaction costs will be positive, which means that you will incur an implicit cost to trade. Next time, we will take a closer look at the implementation shortfall method of calculating implicit transaction cost. This will further help us understand the costs incurred while trading. Over the last few videos, we have discussed the importance of transaction costs, the two types of transaction costs, and how to calculate them using various benchmarks. One particular way of calculating transaction costs is the implementation shortfall method. It measures costs from decision time and also includes an opportunity cost for the unexecuted part of an order. In this video, we will break down the implementation shortfall method into four separate components, namely delay costs, change in midpoint cost, effective spread cost, and opportunity cost. This will help us better pinpoint what is likely causing our transaction cost to be very high or very low. We will illustrate computation of these four components using an example. Let's first define the four components of the implementation shortfall method and how to compute them. Then we will revisit our example from last time and calculate the value of each of these components. The first component is the delay cost, which captures the cost due to the delay between deciding to trade and the order's arrival in the market. To compute the delay cost, we need the bid-ask midpoint at decision time as well as at arrival time. The delay cost is the total order size capital X times order direction times the difference between arrival time bid-ask midpoint M sub 0 and the decision time midpoint in arrival time and execution time. For each trade, it is the trade size X sub j times the order direction times the difference between the execution midpoint M sub j and arrival time midpoint M sub 0. This is summed up across all your trades. The third component is the effective spread cost. This is something we have already discussed. For each trade, it is the trade size X sub j times the order direction times the difference between trade price P sub j and execution time midpoint M sub j. This is summed up across all your trades. Finally, the opportunity cost is the loss due to the non-executed part of your order. It is the difference between your order size capital X and the total quantity traded, which is the sum of all X sub j's times the order direction times the price of the last trade of the day P sub n minus the arrival time midpoint M sub 0. Let's revisit our earlier example. Your order size, capital X, is for 1200 shares. Your order direction is +1 as you want to buy shares. Decision time midpoint M sub D is 46.065. Arrival time midpoint M sub 0 is 46.15. Midpoint at the time of your first trade is 46.035. That at the time of your second trade is 46.01. And the price of the last trade of the day, P sub N, is 46. The delay cost is 1200 times 46.15 minus 46.065, which is $102. Prices increase after your decision to buy, and hence there is a huge delay cost of $102. Had prices decreased during this period, the delay cost would have been negative. Change in midpoint cost is 460 times 46.035. Change in midpoint cost is 460 times 46.035 minus 46.15 plus 530 times 46.01 minus 46.15, which is a negative 127.10. Your change in midpoint costs are negative as the midpoint decrease between order arrival and order execution. Since you're buying, this price decrease is favorable and is represented by a negative cost. The third component is the effective spread cost. We already calculated this to be $17.5 last time. The final component of the implementation shortfall method is the opportunity cost. We already saw that 210 shares of your order were not bought. So the opportunity cost is 210 times 46.03 minus 46.15, which is a negative 25.2. Adding the four components of 102 minus 127.1 plus 17.5 minus 25.2, we get a negative 32.8, which is the same number we got when we calculated transaction costs using the implementation shortfall method. The decomposition helps pinpoint that delay costs were huge in this case. Transaction costs could have been lower if there had been a smaller delay between decision and order arrival. This brings us to the end of this course. This course focuses on the building blocks of trading. This included learning how to read financial statements and understand a company's current financial health by examining its financial ratios. We next discussed the risk-return relationship, the idea of diversification, and some common asset pricing models. Finally, we looked at some of the mechanics of trading. Specifically, we looked at what orders a trader can use and how the order book worked. We then focused on transaction costs, which are real costs borne by traders. These costs reduce returns earned by investors. Later in this specialization, you will use these topics that we have covered in this course. I hope you enjoyed the course as much as I did bringing it to you. Goodbye.